Okay, hello everybody, and welcome to the stream. I have with me Connor Howell, who is a long-time chatter of mine and is also a graduate student who works in shadow banking and a bit of post-Keynesian economics / modern monetary theory. So that's what we're going to talk about today. So thanks so much for joining me, Connor.
Yeah, it's great to be on. Long time listener, first time caller, I
Yeah,
guess is the radio joke.
yeah,
Um,
that's it. No, I mean, I'm really interested to explore with you because you often bring things up in chat, quite interesting details and tidbits of the financial system, and there's obviously a limit to what you can do in chat, especially since I have to restrict it to one message every 30 seconds or something to avoid people
yeah.
talking about Stalin. So yeah, if it was just you, I wouldn't have to do the restrictions because it'd be interesting. But yeah, anyway, so let's just start shadow banking, right? Like I've for a lot of people, and I think a lot of economists as well, and maybe even some people who consider themselves experts on the sector, it can be really hard to understand the financial system, and perhaps nowhere more so than the shadow banking system, right? So I've read loads of books about it. I've read articles. I've talked to people, and then every time I do it, I'm like, oh yeah, I understand it for about 30 seconds, and then after that, I've just forgotten. So it really feels like in one ear and out the other, and I'm sure a lot of people share that feeling. So can you please try and explain the shadow banking sector to us like we're 5 years old?
Yeah. So I just want to say I totally sympathize with that. I study shadow banking activities almost exclusively. It is so complicated. There's just like you said, there's so many moving parts. I'll just start by saying I think part of the problem is that shadow banking is a bad term. I think when I tell people like, oh, I research shadow banking, I think they think I'm about to tell them this crazy conspiracy theory about, bankers then in the back room doing all these crazy things. Essentially, the academic definition of shadow banking is it's banking like activities that are performed by non-banks, which is not really that helpful of a definition either, because you're like, well, what do you mean? Um, the way I like to think of it is that shadow banking is about activities which on a balance sheet or mathematically resemble banking. So a good example of this that I think has become a hot topic again, but that a lot of people were familiar with because of the role that they played in the great financial crisis, gosh, what is that, 12 years ago now, is mortgage-backed securities. So in a mortgage-backed security, you have home mortgages, which have been created by traditional banks. So you want to buy a house, the bank finances it by lending you the money. Well, then you can take a lot of these mortgages together and you can pool them, is what we call it, into one area. Usually it'll be like a new company is made just to hold them. And then bonds are issued in order to pay the banks for the mortgages. And what this allows you to do is it allows you to buy a piece of a pool of mortgages. Um, and so this gets called shadow banking because this occurs outside of traditional banking activities and regulations. But it essentially allows an investor to play the role of the mortgage lender because they can put up some money to help finance, building or purchasing a home without actually taking the place of the bank itself. They don't have to do the same underwriting and all of that. Um, there are other important parts of shadow banking. Usually the list will be something like, it's mortgage-backed securities, asset-backed securities, credit default swaps, and then repurchase agreements. These things that interact with the credit market but don't occur on a bank's traditional balance sheet.
So can I ask, you spoke about mortgages, right, and mortgage-backed securities. Does this mean that the shadow banking sector in general depends on the kind of normal banking sector, right? Because in that instance, it does. They need the mortgage to create their own sort of securitized products. But is that always the case, or can the shadow banking sector kind of function alone?
Yeah, so it does often depend on the traditional banking sector. Again, it depends on what specific part we're talking about. So if we were talking about repurchase agreements,
Yeah.
which are often done with treasuries or government issued bonds, then I would say, it can largely function outside of the banking sector. That it's if the government, issues a lot of bonds, um, and most of that actually will be to banks. Another part where this gets complicated is shadow banking activities very often occur inside of banks as the company itself. So like
Right.
I work for KeyBank, which is a bank here in the United States. I work in the real estate capital group working with mortgage-backed security pools. So I'm a shadow banker inside of a bank. And this is very common and even was in the great financial crisis. I would say as a whole that shadow banking relies a lot on banking.
Yeah.
Um,
And
there are some
even in
activities.
your other example, right, it relies on government debt. So
Yeah.
it's like, I mean, I suppose, and we can get into this, and you sort of were hinting at this just before we went live, but you, in a lot of people's heads, I suppose the relationship might seem a little bit parasitic. Is it parasitic on like the rest of the economy, whether you're talking about government bonds or like mortgages, and is it just a way for like shadow banks to turn a quick buck from these things, or is there a sense in which, firstly, they do things as standalone, but secondly, when they interact with these other institutions and parts of the financial system, they add something?
Yeah. So we're coming out right out of the gate with the spicy questions. Yeah, I mean, I suppose it, and I hate to give like the economist answer of it depends, right? So on the one hand, we could go with like
Mm,
the Michael Hudson view, which is that the entire financial sector is parasitic
mm.
and just, moves rents around in the system. If you hold that view, then yeah, shadow banking is absolutely, it's just parasites on parasites. If we were to take a financial perspective, and this is something we can talk more about because I think this is something that's often missing from the economics of shadow banking and finance and financial economics as a whole, is that financiers and economists are often on completely different pages about what's happening.
Mm.
Shadow banks, shadow banking does provide services to the financial sector. So this is something that uh, gets talked about a lot, like Zoltan Posan. I'm probably butchering his name, but he's kind of one of the more well-known experts in shadow banking. He's more of a mainstream type economist who works in the financial sector. And one of the things he talks about a lot with shadow banking is that you have these different mismatches. So a common one is a maturity mismatch. So when you're a bank, a traditional bank, you have deposit accounts, and those get thought of as like short-term liabilities. Because you could show up at any moment and say, hey, I don't know where you bank, but you go to your bank and you say, I want to withdraw my money right now.
Yeah.
We call those demand deposits that you can withdraw on demand
It's
or
basically
spend.
it's basically money, isn't it?
Yeah.
It's almost indistinguishable from cash in the sense a deposit is, in the sense that you can basically use it whenever you want on demand, as much as you
Yeah.
want, right? As much as you've got.
And I would go the step further, and I wouldn't say it's like money. I would just say that is
Yeah,
money.
it
It
is
it,
money.
it
Yeah.
is it is a type of money, and that's the post Keynesian side of me. Um, but yeah, and so when you think of a mortgage, for example, so if you're a bank, and I'm just talking about traditional banks, so
Hmm.
you're what we call a depository institution. So you accept deposits from your customers, and then you make loans to other people. Well, and to be clear, I don't know what the case is where you're at in the United Kingdom. In the United States, we have 30-year mortgages. They're fixed rate and prepayable. We can get into
Yeah.
those details later because they do matter. Um, Whereas deposits, like we said, can be withdrawn on demand. So we have this mismatch between maturities where, it's going to take me 30 years to get all of the mortgage money back. But Cahill might show up tomorrow and want, his $50 right now. And so where shadow banks can come into that and other financial activities is they can help smooth these kinds of mismatches. And so, like with mortgages, like you're a bank, maybe I don't want to wait 30 years to get paid back, and so then there's this investment banker that comes along that says, hey, I'd love to buy your mortgage from you because we're going to pool it and securitize it so we can issue these bonds. And it's like, oh, great. Well, now I can have my, $500,000 back right now, or, however much it is. And so, especially if I'm in a situation where like maybe withdrawals are higher than I expected, the shadow banking sector can help me get my maturities back in sync.
Mm.
Um,
Yeah. So you've got like the deposits being demanded here and now. You could face a sudden spike in demand for those from your customers. The extreme scenario of that is a bank run, right? Basically, where there's not enough for people to withdraw. And what the shadow banking sector does ideally is lets you kind of fund those fluctuations, and get money for some of money now for some of your maybe more direct long-term investments like a mortgage, right, and get paid for that now, even though that's extended over 30 years. And the shadow banking sector comes in and says, hey, we'll give you money for it now and we're going to securitize it and blah blah blah, and then then you can continue to fund your operation. So I mean that sounds like that sounds like a pretty good function. I suppose my question is, that's quite similar to central banks, right? That's kind of similar to like the role of central banks. So why do we need both? Why not why not just one or the other?
Yeah, so I mean that's a really good question because I mean some people probably would argue, if we were more like free bank types, we would just say, well, let's just get rid of the central bank because clearly the private sector is able to,
Yeah.
do these things. It can provide liquidity backstops, like credit default swaps are a good example. They're often described as like puts, to use a financial term, because they insure you against losses. If a loan were to default on me, but I had a credit default swap on it, I would be okay. It'd be like insurance. On the other hand, you could go to the other side, and I know people like this. My roommate is a good example of someone who thinks, well, the central bank can just take on all of the activities of the banking sector. And there's clearly some advantages to that approach because, and I know that, you mentioned I've got kind of an MMT background. The federal government is better at providing a backstop for the financial system than the private sector could be because, it can, Jerome Powell can just summon up the reserve balances needed to prop the system up. Whereas in the private sector, that's not always the case. Like we saw in 2007, when there was a very, big credit default swap market that was supposed to insure against these sort of, tail risk events, it obviously didn't work out because of a lot of banks like Lehman Brothers, which isn't a bank, but Lehman Brothers went under and could no longer honor its credit default swaps. And so maybe we don't need both. I'm sort of the view that maybe we don't need shadow banking at all. And maybe not even so much if we don't need it, but maybe we really even shouldn't want to have it, because it does introduce a lot of risks into the system. I mean, and I don't think this is controversial now. If I'd said this in 2006, I would be a lunatic. But now I think most people agree, like, maybe mortgage-backed securities cause harm in a lot of ways. Even so, the New York Federal Reserve in 2022 released kind of this report on mortgage-backed securities, and not only in that paper were they skeptical of a lot of the supposed benefits of mortgage-backed securities, but they identified that there's all these risks in the system. I try my best not to come down too hard either way because I think it's here to stay, and I don't think these products are going anywhere. And so I see my role as just trying to understand the role they play in the economy. Even if I think I probably lean toward maybe we should at least regulate them a lot better and downplay their importance in the financial system.
I mean, yeah, 2008 proved that the whatever risk management those banks, shadow banks, do engage in, it seems to be at best highly localized, right? And so it might seem to manage and reduce a risk for the shadow bank and the other institution they're interacting with, say the normal bank, that it will reduce the risk for those two actors in that moment. But if you've got a whole pool of these extremely complicated assets that all with different risk profiles, you had mortgage tranches, right? Combinations of mortgages that were just hundreds, I don't know, thousands of mortgages, and then they sort of got the other ones and put those got these groups and then put them together into even bigger things, and it's very difficult to know what the underlying asset actually is. And I think the bet was kind of I mean, Nicholas Nazim Taleb talks about this, right? But the bet was kind of the risks would move in different directions. So if one person defaults, another person's actually doing really well. But when the whole system goes down, that's when you get this collapse, and that's where central banks step in, right? That's where you need the central bank to shore up the whole system, not just like for individual actors.
Yeah. So to sort of follow up on what you said there, the tranches of tranches, like
Mm.
it, just for the sake of the audience. So what we're talking about there, what are called CDOs or collateralized debt obligations. Um, they are not the only product like this, but I think they were sort of the one that caught all the headlines in 2008. But a lot of these products will be split up into what are called tranches, which, if I understand right, just means slices. I don't know why we don't just say slices.
Well, it's all you've got to make the jargon as obscure as possible so people don't
Yeah,
understand it. You've got to make up new words at every opportunity. Yeah, slicing's much better.
yeah, financial economics, like all areas of economics, just has a ton of this jargon that's
Yeah.
hard to get through. Is essentially the idea with the tranches is that um, you'll have like on one end you'll have like what are called like more senior notes, and on the other end you'll have junior notes. So if we imagine that we'll just keep it simple. We have two tranches in our mortgage-backed security pool or whatever we're talking about. And the senior one always gets paid its dues first. So whatever its coupon is, debt service, whatever we're calling it, the senior one gets paid first. And then it sort of waterfalls. So if the people with the debts, the debtors, they make all of the payments they're supposed to, then everyone gets paid. Well, let's say, we split it into two even tranches. Uh, and the borrower only pays half of what they're supposed to. Well, the senior note holder, they're okay, and the junior note holder, they won't get paid anything. They've experienced a default. Now, in order to compensate them for this risk, they get to take a higher yield. Um, and essentially, you can work out the math. So you're like, well, if it's a 5% loan, we can split the interest rates between all the tranches such that the weighted average will come back to what the total average should be, like of what the original obligation was. Well, what people started doing is they started buying these tranches. They were buying specifically the more junior tranches, and then they were packaging those into collateralized debt obligations and then retranching them. And then some people not only were doing that, but they were taking tranches from those CDOs and making new CDOs, which are called like CDO squared or synthetic
Mm.
CDOs. And I mean, really, I mean, the game didn't get this far because the market fell apart. But you could imagine CDOs of CDOs of CD. I mean, as
Yeah.
long as there's someone there willing to buy them and repackage them, there's really no theoretical limit to how complicated a financial asset could get.
Yeah, I mean, to go back to the beginning, this is all done in the name of providing funding and liquidity, right, for the
Mm-hmm.
banks themselves. I mean, at at this stage, when you've got a CDO squared, is that kind of lost? Do you just sort of, I mean, is it just because I think the popular perception of the crisis, if you watch like The Big Short or something, is basically just that this was a way to make a quick buck for some of those inside the sector, right? And so they didn't really care about providing liquidity for the system or reducing risk, right? It was like, can I package this together and sell it to make money for myself? I don't care or care where the original mortgages come from. Maybe I don't even know that much about the actual thing that I've created, right? But I mean, is there a defense of this? Was it kind of helping anything, or where does it go, or where does it go from helping to not helping?
So if I were to really steel man
Mm,
this practice, and
yeah,
like, I mean, we were ignoring important details.
yeah.
There was a huge demand for fixed income instruments, which usually includes things like bonds, money market accounts, things like this, where they're not like stocks where you don't know how much you're going to get. With a bond, if everything goes great, you can calculate exactly what you get. And there was a huge demand for that. Now, there's a lot of debate as to why there was that demand for it. Some people would point at the trade deficit in the United States, and they'd say, well, all these dollars were flowing somewhere, and the foreigners holding these dollars wanted to roll them into fixed income assets. Um, there are people who disagree with that. There's a whole debate about this even now. I mean, the great financial crisis is far from settled, I think, in either economics or finance. So that you could say, well, these CDO issuers and these CDO squared issuers, they're only responding to a demand for fixed income assets. Now, another really important part of this story, and this is where the steel man ends, is that rating agencies they were slapping AA and AAA on these products. And the theory with mortgages, especially the subprime mortgages, was like, okay, and just real quick, a subprime mortgage is just a mortgage that pays a higher than market rate of interest, usually because that person, maybe has a bad credit history or they don't have as much income. They don't meet the normal credit underwriting standard. And you had people in like 2006 saying, well, it's not a big deal because they're geographically spread out. You have these mortgage-backed security pools where they're buying in 18 different states. And so they're saying, well, this gives it a high degree of diversification because they should be uncorrelated. Like why would housing prices in Los Angeles have anything to do with the price of a mobile home park in Alabama? Well, as we saw, there is correlation there. When the markets went down, everything, I mean, it wasn't equal everywhere, but when the bubble popped, everything came down. And so a lot of investors were like, well, Moody's and S&P, they say that this is AAA. That's like almost as good as government debt, but it pays a much higher yield. So this is a no-brainer. Like it's easy money. And I don't want to sound tinfoil there. I don't know that this was a conspiracy or anything crazy like that. But one thing that's important when you talk about this in the United States is that the people that pay the ratings agencies are the issuers of these instruments.
Yeah, yeah. I mean, there's I guess the non-conspiratorial way of saying it, the economisty way of saying it, is that there are like the wrong incentives, right? If you've got that. I've also seen it argued that it was actually kind of a, contrary to the invisible hand mantra, it was like a consequence of competition, really.
Yeah.
Because in order to attract to these clients, the ratings agencies were like, oh yeah, we'll give you better ratings, which obviously just completely defeats the purpose of like an objective and transparent rating for these things, right?
Yeah, exactly. I mean, it's like you said, and I do think competition plays a role here because there's only so many mortgages that can be securitized. So that's kind of competition on the supply side, and that's often where the finger gets pointed when talking about the great financial crisis, specifically the subprime mortgage part of it. Is I've read things that suggest that by 2002, essentially the supply of normal mortgages had been tapped. Not everyone agrees with this. I just want to be clear. All of these debates are alive and well 20 years, almost 20 years after the fact. And that this encouraged mortgage lenders to lower their underwriting standards.
Yep.
Because you get a fee. I mean, we can go more into the details of how you structure a mortgage-backed security deal. It's a lot more complicated than you'd think. I don't even feel like I fully understand it, and it's all of its parts. And I work in that industry. There's just so much going on, but you get a fee and you get cash now. So if I lend out a mortgage for $100,000, and you come along and you say, hey, I'll give you $102,000 because I want to pool it. Okay, great. I just made like $2,000 basically for free, and I don't have any of that risk on my balance sheet because you're going to take the mortgage. If they default, that's like we're buddies, but that's your problem, not mine. That doesn't have anything with me. And so it's essentially risk-free money for mortgage lenders. And so that's and I think that's not a controversial view at this point, that bank lending standards definitely jumped straight off a cliff once they realized how much money could be made from this.
Well, this is the thing, right? It's like it's one thing to say that you're responding to the demand for these instruments when you're in the shadow banking sector and you're designing all of these different CDOs and everything, but clearly there was a further impact, even if that was the case initially. Clearly, that in turn drove banks to make more mortgages and make mortgages with strange terms, ballooning payments. Somebody mentioned in the chat, right? Much lower standards, predatory lending. the type that really were implicated in the financial crisis, right? So I mean, there's a question of whether this actually came from the shadow banking sector itself. This demand actually came from the shadow banking sector itself, rather than it just sort of responding and facilitating.
Yeah, and I would say that's at least in part accurate. I mean, it's maybe to use a simpler view, we can, if we're talking about, I don't know, apples, it's always like the go-to
Yeah.
economics. Like we're talking about apples, there's like the farmer, then there's the co-op that buys the apples and they sell it to the wholesalers who sell it to the retailer.
Mm.
And so I would say shadow banking is a lot like that, where, they're, because most people, and I think maybe one defense of the term shadow banking is just that we don't see most of this.
Right.
It happens all around us, which is why I think it sounds like a conspiracy theory sometimes,
Yeah.
because it's like all around you there's shadow banking, and it's much more mundane in practice. I mean, it's my 9 to 5, so it's a little more typical. But in that case, so you have all these layers of middlemen where like you're just like, well, I just bought a house and the bank paid for it, and in the background you're like, no, your mortgage was picked up with 500 others that have these specific characteristics and pooled to service these specific clients, both on the banking side and on the investing side. And then rating agencies got involved. I mean, I think pinning down one specific set of causes and factors is going to be maybe even impossible, just at least very difficult. We can say broad things, but because another thing that makes this complicated is every one of these products is unique. I mean, even if we're talking about commercial mortgage-backed securities, which is the area that I work in, I can have two loans that are both multifamily, like apartment complexes in the same city, and the loan terms will be different. And then they'll get pooled into one pool, which will have its own specific terms. There will be a pooling and servicing agreement between the parties that made this deal, and they're all unique. And so it gets really hard to generalize too much because every single product floating around is different. Whereas like with a government bond, it's like treasuries are treasuries. I don't know that they've really changed much ever since they've been traded.
Yeah. I suppose there's a defense of shadow banking that's not, I mean, it's not a defense of how it looks specifically right now. And it's not really an argument against regulation, but it seems the way you've described it, and especially at the beginning, it does seem like something that people, a type of insurance, right, or a search for liquidity that people would kind of seek to do one way or another, right? So there are arrangements that communities make where they might pool their money or something like that, and other types of insurance that a business owner might seek. And then I guess the question becomes like, how do you ban that if that's something that people are like going to need in a market economy? If they're like, if a business goes to a bank and says, can you give me some kind of insurance instrument on my income because my income's very volatile, maybe I'm a farmer, I don't know, right? Then that seems like something that just emerges naturally, and then does that bank just become a shadow bank when it's providing that kind of instrument, right? So I mean, is this, you said you'd quite like to regulate it very strongly, or perhaps ideally even not have it, but is there not this role that it fills that would otherwise go wanting?
Yeah, I think it does. And I think in a lot of ways, it's just a natural extension of the banking system. I mean, it's, like you said, there's these different needs that come up. So for corporations, if we're talking about like, traditional firms, they face all sorts of funding requirements all the time, whether it's capital expenditure, like I want to build a new factory. If it's, oh no, we forgot we have this bond issue that's due in like 6 months, and we really don't want to get downgraded by S&P because that'll make borrowing more expensive. But maybe we also don't want to issue bonds. So what we do instead is we turn to the money markets, and we sell what is called commercial paper, which are these short-term obligations that usually are defined to have a maturity of a year or less. And it can provide benefits to a lot of people. So like a lot of people don't even know that what they think of as their savings account at the bank is actually a mutual market money fund account, where their money every day from their savings account is being swept to and speculate and invest in these, this commercial paper and these other money market products. And so on the one hand, you're like, oh, that's cool. I get like a nice little yield. I get a little bit of interest. And then from the business's point of view, this is an important source of fast, short-term funding to meet their needs. Even if it's something as banal as like, well, payroll is due on Friday. Could we have the treasury team within the finance department go and hook us up with a couple $100 million without getting us tied up in this big, complicated bond issue or something like that?
Mm,
So
mm.
it does provide services, and I will say, and I hate to be like this, even when it comes to regulating it, it's very difficult because shadow banking, almost by definition, is those financial activities which exist outside of the banking regulations. They're not totally unregulated. It's not the Wild West, but I think that if we were like mortgage-backed securities, I think if we just said we're gonna just Joe Biden today says
Mm.
no more MBS, it's just against the law. I think it would only be replaced with something else. There are finance guys that are paid to sit around and dream up these products. Financial engineering is what some people call it. So I don't even know that we could really just get rid of it. The regulation, I think, has to come more on the banking side to say, well,
Mm.
banks are already very well regulated. Well, people might contest that. They have a lot more regulations than other financial institutions. And so we might say, well, a good example, I think, could be something like risk sharing, saying, well, you're allowed to sell your mortgages to be securitized because there is a demand for that. People want to own mortgages, and it does maybe in theory help make mortgages cheaper by
Mm.
bringing this, source of liquidity into credit markets. But maybe we say, actually, you need to keep more of that risk. You
Yeah.
can sell 80% of a mortgage or something, whatever number, that way if you do make a lot of subprime mortgages and we go back to 2007, then you're going to be punished. You're not going to be able to sit there and be like, oh, that's not my problem. Like, they
Mm.
bought those.
Yeah, yeah. That seems like a good way to reduce risk a little bit and also maintain like accountability, right? I mean, one proposal that I always found interesting and compelling as somebody who doesn't really know that much about it was Ha-Joon Chang's proposal. And he basically said that we should treat financial instruments like drugs. And if there's one that's been invented, a new one, it has to go through quite a serious vetting process before it's allowed to be used. I mean, have you heard that before, that proposal, and what do you think of it?
Yeah. So this often, I think it's phrased as like the financial FDA,
Yeah.
something where it's like, um, so I think it's a good start. It is kind of strange that we wait to regulate these products until after they've caused a crisis. Um, because that, I mean, and that's, I mean, I'm exaggerating a little bit. There were regulations on mortgage-backed securities before then. We have in the United States, we have an entire body of securities law that, rules out things like fraud, ideally, and these other problems. Like you have to disclose what you're saying. But most of the regulations around mortgage-backed securities came into existence in like 2009 and 10 and onward. It came later. Whereas, like, if the government did that with drugs, that would be crazy. If we're like, oh yeah, we found out this new cold medicine, it gives everyone that takes it brain cancer. We'd be like, why did the FDA even allow that?
Mm.
On the flip side, I think where that would be hard is that the financial system is kind of unpredictable. I can bring you, let's say I come up with new, I don't know, I come up with this new asset-backed security where I securitize your Patreon account, and I say I'm going to issue bonds backed by your cash flow from Patreon, and in return, the bonds get to take that cash flow, but maybe then you go use the money to buy, I don't know,
It's
a
a
new
good deal.
micro.
Everyone should go out and buy those bonds. They're very safe.
Yeah. Hashtag not financial advice. Right. But well, and so I could say, well, I have my Black Scholes option price model, or some extension of it where I have come up with, this is how I think the fair price would work in a market. These are some of the things I've explored. but there could be parts of that that I don't realize. I think maybe even medicine's a good example. Like a problem with a lot of medicines is that they're like, oh yeah, it cures the flu, but it gives you really bad stomach pain because the body's really complicated. And I'm not a doctor, so someone out there's probably like not agreeing with me on that. But the body's really complicated and it interacts in these weird ways. And that's what happened even in the great financial crisis was, you had these complex interactions between like credit default swaps, CDOs, the traditional banking sector. And in large part, I would say a lot of people maybe didn't like a lot of people didn't see it coming. I don't think there's like a shadowy cabal out there that was like, we're going to crash the banking sector. It caught a lot of people by surprise. Now, there are some noteworthy people who claim to have foreseen it, and we don't have to get into that because I don't know that I agree with all of them that they really did foresee it. Because it's like I say, it's just really complicated.
Hmm.
And people tend to focus on one part of this story. With the great financial crisis, they're like, it was mortgage-backed securities, it was the bankers, it was the Federal Reserve. And it's like, well, it's probably a lot of these things, interacting together and in ways that are just hard to foresee.
Yeah, yeah. So, I mean, one corollary of this, and I wanted to ask this because actually quite a few people in chat brought it up, and I thought it was a good question. Like, to what extent do you think actual fraud was a big factor in the global financial crisis, is a factor now? Like, how would you define this kind of fraud? Like, how could we call it out? Is it widespread? Has enough been done to prosecute instances of it, and so on?
That is a really good question. And I'll just be honest and I'll say it's really complicated. I've seen views that range from like it's only fraud. Like
Yeah.
if everyone had been just honest, nothing would have happened. It would have been great. We'd still be riding the boom of the 2000s all the way over to like fraud plays no role. The financial system is just unstable as a natural characteristic. So this might be something like the Hyman Minsky extreme over here of like, financial markets just tend towards instability. I sit closer to the side of fraud not being that big of a deal. It's bad. It's immoral, right? Like I'm not saying go out and just start defrauding people. It does matter. And I do think fraud happened, but fraud is complicated, right? Because it's, as a legal term, it requires you to knowingly engage in this activity. And I think that many, especially if we're talking about the great financial crisis, I think some people may have been aware that they're selling total garbage and, they know these assets are toxic. They don't care. I'm sure that did happen.
I think there was some evidence of Goldman Sachs. They had some private phone calls and they were like, this is crap, we're palming it off. Of course it'd be them. But I guess that doesn't mean that was always or even often the case.
Right. And it's hard to say, right? Because unless you catch someone directly, it's hard to know.
Being like, I am defrauding this person.
Yeah. Like if someone happens to say in a phone call that's recorded by the FBI or whatever, then it's really easy to be like, well, that's the case.
Yeah.
I think personally that even if we took fraud out of the equation, that we would still see these sorts of financial crises. They may not be as bad. Maybe fraud exacerbated the great financial crisis. But again, I think genuinely a lot of people just didn't see this coming. Especially in the financial sector, you tend to focus on this one narrow part that you do. There's like this one job that you have in the greater system. Like I work only in servicing. I don't see the deals get originated. By the time they hit my desk, that deal has been made. It is settled. It's probably even existed for years before I got to it. And I'm just there to see the loan through, to its finishing steps, whether that's maturity or default. So I think for many people, I don't think they had fraudulent intentions. Again, I don't want to discount that it did happen. Like, right, it does happen. Now, as far as have we done enough about it? So I think one danger of the fraud story is that this got really focused on. People were like, it is Goldman Sachs, it's Lehman Brothers, this boys club of frat bro, Wolf of Wall Street types. And they exist. I don't want to discount that. These fraudsters did exist. But everyone kind of was like, that's the problem. It's them. Shadow banking would be perfect if they didn't exist. And so a lot of the regulations that came in the aftermath were focused on that. So like an important one, and is Regulation 17G5,
Of
which has
course.
kind of become yeah, right. It's well named. It's very creative. And it's essentially just a regulation that controls how information about some of these products passes around. So let's say a rating agency wants to review a rating they made of a bond pool of, I'm sorry, a mortgage pool that that bonds have been issued against. Well, there will be someone who is the servicer. This is the bank or entity that is ultimately responsible for monitoring the loan and doing the day to day of making sure they pay, making sure they submit whatever documentation is required. Well, the 17G5 regulation says that there has to be sort of like an appointed middleman in these communications, that there'll be some entity that sits between the servicer and the rating agency and monitors their communication and stores it. Because one of the things that got highlighted in the great financial crisis, like you said, these phone calls or these guys texting each other, be like, oh, MBS is crap, sell, 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 like, and that is fraudulent and that is worth regulating against. But I guess I have more of like a Minsky view that even if we imagine the world is full of angels and we're all just benevolent people, we would never defraud each other, we would never do this. There was just this tendency. Times were good in the 2000s. Housing prices only went up and interest rates were relatively low for most of the period. So people sought higher yields. And so we got a speculative bubble in the housing market. I don't know that that's fraudulent. And I think maybe a lot of people bought into this story of, well, these subprime mortgages, we're helping people buy houses. Like, a lot of these mortgage officers, these are people in your community. They're not, these originators are, a lot of them are kind of these like almost like mom and pop shop. They're a lot like insurance agents. I don't know how that works in the UK. In the United States, a lot of our insurance sales happens in these small businesses that are kind of like franchises. And so they're like, yeah, I'm helping people in my hometown buy houses. Yeah, and they don't have great credit and they're not rich, but I'm still able to hook them up with something. And as you go further up, you might find some sinister motives. Like I'm sure some mortgage banks were aware, like, we're just manufacturing crap and we don't care because we're selling it. But even if, like I said, I think even if no one was doing that, we would still have had a housing bubble, that there still might have been a run on the shadow bank. Because like in the Minsky theory, it doesn't really even boil down to fraud. It boils down to, the longer that times are good, like as he famously says, stability creates instability. When times are good, it blinds you to the risks of the past. And so these margins of safety start to come down. You're like, oh, well, or even, I mean, as you probably know, there's like this phrase that was coined, the great moderation. All these economists patting themselves on the back, like we've defeated recessions, like times were good. It was very optimistic. And so people made bad choices. Some of them were fraudulent.
Yeah. Sorry. It is easy to forget quite how optimistic it was. I mean, I was pretty young and, I'm guessing you were as well, but people really just thought that, house prices were going to keep going up. Home ownership was expanding. They thought there hadn't been a recession, certainly not a serious one, for a very long time. And everybody just sort of bought into it. So, yeah, I think the idea of like schemers driving it, even if they did exist, is too convenient, I suppose, right? Like it's too simplistic an explanation, because the problem is quite deep and systemic, and I don't want to psychologize everything, but there is this real human tendency. I mean, there are loads of, with Minsky, right, stability is destabilizing. Every time an investment pays off, I'm going to take a little bit more risk. That's something that I think we do have quite a lot in our everyday lives, right? I mean, I don't know if you go to the gym and like you're sort of going up in weight every time, and then you're like, oh, that was easy, I'm going to do another one, until you get to one like you just go up 2 kilograms and you're like, oh shit, yeah, that was a mistake, right? And
or you hurt yourself.
Yeah. And I think, is it called the Peter principle in management, where you get, I can't remember what it's called, you get promoted to the level that you're incompetent, right?
I think that's the name.
I think it's the Peter principle, but there's a lot of this stuff. Now, that's not to say that capitalism isn't a system and therefore we can't regulate it in a certain way to prevent these things, because that is of course true too. But I think it's just important to appreciate like how complex and multifaceted this is, because there's a lot driving this. There's these psychological factors, there's these political factors, there's like these big corporations, of course, and maybe fraud, but there's also these small, what you call mum and pop companies in the US, right? So there's all of this going on. I mean, we have already discussed this a bit, but Minsky called for something like the socialization of the sector, right? I think that was basically what he called for. Do you agree with that?
I think it's complicated. So, and I promise I'm not trying to be evasive about my views or anything like that. I would say I'm left of center. I do like, as a post Keynesian, I follow in the footsteps of Keynes. So I do think there is role for government intervention. My one concern about when people talk about socializing or nationalizing the financial sector, and I'm not saying you or anyone in the chat has said this, but it's sort of like an extreme view. Some people like, well, couldn't the Federal Reserve just be the bank? Right. Like they can just do it all. They can have citizens deposits, which I do like actually, and they have taken some steps towards providing payment services to the public, which is good. I'm okay with that. Really, for me, where it comes to credit creation, so, and I know that I've been called like a libertarian type of this. I do think that the profit motive does play an important role in credit creation, especially if the risks are assigned correctly. If you have to bear the brunt of your poor investment choices, I think that's important because the high level goal, right? Maybe in an ideal world, what the financial system should do is allocate capital and other resources towards a productive end. That doesn't always happen. And maybe you argue it doesn't ever happen really. And I worry about the idea of the government being able to act as an underwriter. Not that it can't, it's not that it's too complicated or too hard. There's some brilliant people that work at the Federal Reserve. I'm sure they could be loan officers if called on. But, and maybe this is where we can get a bit into the MMT side, is that the Federal Reserve is not bankruptable. It can't go insolvent really, neither can the federal government. And so it sort of takes away this risk management element, whereas, at least with a bank, and I know people are going to respond to this because this would be my response as well. The government will bail them out. They'll be okay. But it does play a role to regulate them because they say, well, as much as we'd love to, summon $1 trillion of credit money onto our balance sheet, in addition to the government, probably not approving of it, what if it goes wrong? We're all out of a job. I'd like to keep my company car and my bonuses every year. So I do think there's a role for like a market feedback in the credit system.
Yeah, it seems that while you can see the Federal Reserve, I think people get frustrated or maybe not frustrated, maybe outraged is a better term, when there's this direct interface between the Federal Reserve and the financial system, and even between other corporations as well. And it's like, we'll bail you out, we'll buy your financial instruments and stuff. And, you and I are sitting here like, well, why can't you buy our financial instruments? You know what I mean? Like, yeah. It seems very unfair. So expanding that, Francis Coppola's among those who's kind of agreed with you there and called for something like a UBI citizens bank account. I think Yanis Varoufakis has as well. It's a fairly common suggestion from some economists. But then there's the question of like, is that just can you just have that as the banking system? Can you just have that as monetary policy and like that's the instrument? Because it feels like for a start, I think even if you had that system like a UBI through a direct bank account with the central bank, you wouldn't want them to adjust it, right? So there wouldn't be any, so that if we go into a boom, they're like, oh yeah, everybody's universal basic income is going to be reduced, and then if we go into a recession, it's increased. Like, I don't think people would like that, right? So there have to be these instruments and these interactions with the rest of the financial sector, right? And that's where like traditional monetary policy comes in. So I think people, Reform UK. I don't know if you watched me go through their manifesto.
Some of it. Yeah.
They made the suggestion of eliminating interest on reserves, and that would fund £35 billion. Now that if you eliminate, so this is for everybody. This is and we're in the normal banking system now. We're sort of hopping around a bit, but the Federal Reserve pays interest on its account, on its bank's accounts with the Federal Reserve. Sorry, that was really badly put. But basically, as you and I have a deposit account, banks have a deposit account with the central bank, and interest on the reserves there, the same way you or I would receive interest, is the way that they conduct monetary policy these days. And so if you just say you're going to eliminate that, then you are eliminating monetary policy. And I know I'm getting away from shadow banking a bit, but it does seem to me that when people just like, oh, completely nationalize it, a lot of these instruments and policies that can actually be quite subtle and quite helpful are being ignored. And I think there's just this idea that we can sort of just have the government and the people, but I don't know if that necessarily works. So I don't know what you make of everything I just said.
Yeah, so there was a lot there, so I may have missed some of it. So as far as like interest on reserve balances go, I mean, it's just a policy choice, right? Like,
Yeah.
I know I keep saying this, but my focus is almost entirely on American financial markets, which is a very American economics thing to do. I would love to learn more about how these systems work elsewhere. And I know I've read a little bit about Britain because their central bank confirmed something that some MMT people think. So of course that's now a really important document that got added to our canon. But as far as the interest on reserves, it's just a policy choice. I mean, do you want to encourage banks to hold reserves or not? As far as how much money it will save, so what? It's just it's the interest that's paid is it just gets added to your reserve balance. It's not like the government comes out and actually physically mints coins to give out to the banks. And now it's no more complicated than this. I think a lot of people have this view that there used to be like these fixed reserve ratios where they'd be like, you have to have 10% in the central bank or in vault cash. It's a lot more complicated now. They do what's called stress testing. I don't know what all goes into that. I don't know that it's even public what all goes into that. Essentially, they run like these battery of simulations to see like how you'd perform under these different exogenous shocks. But yeah, so it's just like, because what the idea with the interest on reserves was that it was like a way to, it's simultaneously a way to to get banks to hold reserves while also rewarding them with extra reserves. Because we have this kind of like what they call like the ample reserve system now, where the Federal Reserve just sort of throws out reserve balances like candy to everyone with the hope that giving them reserve balances turns into credit origination, that the banks will effectively loan out reserves. As you probably can guess from an MMT background, that's, there's many people who are skeptical of that. We could also get into quantitative easing. It's sort of similar there. My view on some of those things is like there may be uses for those policies. You can't force people to borrow money. Not anymore. No. I mean, you used to be able to. Like, I mean, Haiti got forced to borrow a ton of money. There's that kind of doing it. But maybe people could argue that's how it is with the IMF. But at least in the United States, in the private sector, people are largely not forced to borrow money in this way. And so if people are just not interested, or if banks are too skittish, we're in a credit crunch, that they're like, oh no, I can't take any risks. The Federal Reserve's already really mad at me because I'm undercapitalized. I don't know that those tools really do that much. And I think that's part of why shadow banking is something worth knowing about. And it's not just interesting in its own right. I'm not like one of these Wolf of Wall Street fanboy finance guys. I don't look at that and think, wow, that's really cool, we should do that. No, it's not like that at all. But it's because it impacts the economy in a lot of important ways. And I know we haven't talked too much about the MMT side, but I think this is maybe one missing component. And to be clear, there are MMTers who talk about this stuff, but they tend to focus a lot on like the government's role. But shadow banking is its own entity. The financial sector does a lot of what it wants, and a lot of the real economy gets shaped. We didn't see that any more clearly than we did in 2008. People were laid off, people lost houses, we were worried about a deflationary trap, and a lot of it had to do with just like shadow banking activities. There was nothing wrong, like the factories didn't blow up or anything. It wasn't like the stores closed. It was just like, well, there's this credit crunch, and so now liquidity is harder to come by, and so some businesses have to shutter their doors or lay off people because they don't know how to pay them in the short run.
I mean, another big question, but what is the relationship between the central bank and the shadow banking sector? Because we just discussed the sort of basics of modern monetary policy, that there are a lot of reserves available since 2008, and banks aren't reserve constrained, and also that in order to conduct monetary policy, the central bank pays interests on reserves, right? But what how has the shadow banking sector been affected by this? Like, what scope does the Federal Reserve, let's stick to the Fed, have to actually influence the shadow banking sector? Because surely it's less, right? Because they don't have such a direct interface as they do with ordinary banks. And when you were talking about credit drying up and that being driven by the shadow banking sector, I was thinking, well, if the shadow banking sector is outsized compared to the ordinary banking sector, does that mean that the Fed is less able to influence it and therefore to influence the economy?
So we have to break this up into two historical periods, essentially before the GFC
Yep.
and after.
Yep.
So before the GFC, it didn't have much direct interaction. Now, whatever choices the Federal Reserve made regarding the traditional banking and credit sectors was going to ripple outward into the shadow banks. Because as we kind of talked about before, the shadow banking sector isn't really a distinct sector that just, it's not like, it's not like cars and apples where like,
Yeah.
the price of apples has nothing to do with the price of cars. The shadow banking sector exists sort of as like a layer of on top of the traditional banking sector in most respects. Like I said before, there are some other kind of edge cases, but for the most part, they interact. And so the Federal Reserve, by making its choices about like what should the interest rates be, what is our monetary policy, blah, 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 it would have impacts. I don't know how direct they were, though, or even how intentional they were. I think before the great financial crisis, you had people like, there were people pointing out that there were issues like Paul Krugman and Greenspan, these kind of guys. I think they were saying, we're keeping an eye out. There's some sort of housing bubble thing, but I don't know that they were yet quite framing it as like, well, how do we interact? Now, after the fact, it's a different story. The most obvious example is TARP, which is the Troubled Asset Relief Program. So beginning in January of 2009, the Federal Reserve decided that not only would it be the lender of last resort, but to kind of quote Perry Maryland, they became the dealer of last resort as well. They decided we're going to be the central bank to the shadow banking sector too. And in TARP, they started buying up lots of these CDOs and mostly mortgage-backed securities, because we talk about shadow banking like it's all these things. Most of it is mortgage-backed securities. That is far and away one of probably the largest part. And so they started buying up, hundreds of billions of dollars of these products just to try to pump liquidity back into the shadow banking sector, because it had essentially experienced a bank run. Paul Krugman, I think he was probably one of the first to say, like, this is just a bank run. I don't know that I agree that it's like just a bank run, given that the view of bank runs is like the Diamond Dybvig model from the 80s. We don't have to get into all of the specifics there, but I have criticisms of that view. But still, it needed liquidity, and it started again up in the pandemic. I don't know if they're still calling it TARP. It may be something else, but anyone who's curious, you can go to the FRED, the Federal Reserve Economic Database, and you can just type in like mortgage-backed securities on hand, and it's published every Wednesday. The Federal Reserve will tell you exactly how much they have, and it just skyrockets way more than it did during the Great Financial Crisis. I mean, like they just like quintupled their holding. Like it's just like it's a straight line up. Now, since about 2022 in the summer, it's been kind of slowly on this linear decreasing path, which I interpret as they're allowing these bonds to mature. They're just kind of rolling them off now. And we can get into this too, if you want to talk about the regional banking crisis in the United States. But so now I would say that the Federal Reserve has kind of a big impact. That they kind of became the central bank to the shadow banking sector as well. I think it's not as direct in some ways because they're not stress testing shadow banking business units, but they're at least there to say, like, hey, if there's a pandemic or a recession, we will try to pump some liquidity in there, especially when you consider mortgages, because mortgages are such a political topic and have been since the end of World War II, because they determine who gets to own a house or not. Especially now that we are going once again through a housing, I'm hesitant to say it's a bubble, but just that the housing prices are shooting way up again. You know, People are really mad about the interest rates that the Fed sets because those are the floor of the mortgage rates. And so, for better or worse, mortgage backed securities are an important source of funding for mortgages. And I think that's where the Federal Reserve focuses its attention right now because of this political housing, aspect.
Well, that's really interesting that you mentioned that, because I sort of wonder whether, especially in Anglo-American countries, I think we're much more we utilize mortgages and credit much more than a lot of other OECD nations. In Germany, for instance, their mortgages are much more limited. Now that didn't stop Deutsche Bank, for instance, from being a big player in the 2008 financial crisis, because it could just buy the American and perhaps the UK ones, right? But I do wonder if you're sort of, if you're thinking about regulating this, can we not cut it off at the source rather than bothering with the sort of shadow banking sector, which is very difficult to regulate, as you've said? Is it not? Should we be focusing on, well, maybe we need to cut down the mortgages, and you should only be able to, borrow 60% of a house or whatever it is in the stricter countries, and then that whatever innovations the shadow banking sector might make, they can no longer make them. And that's a relatively simple regulation as far as I'm concerned, because a mortgage is quite a well-defined thing. Banks are already more regulated. What do you think of that? Do you agree?
My response to that, and I can, if your accent wasn't a giveaway, I can tell you're not American. Go and pitch that to the American people. Tell them you want to make houses even harder to afford. There's no way, absolutely no way we could do that. Now, would that work to achieve the goal you said? Probably, right? Like if we just forced everyone to be renters, then we'd only have to deal with corporate, you know, borrowers in the housing sector. I just don't think it's possible anymore politically.
Political
And
non-starter, yeah, yeah.
and specifically, like, and I know we haven't really gotten into this. What my research specifically was about that kind of brought me here to your channel to talk about is in the spring. I over a few classes, and I presented a symposium. What I did was kind of the history of securitization, and like, if you go back to the 1960s, it's basically non-existent. It just kind of came out of nowhere. It just sort of ballooned onto the scene, and a big part of it is housing, specifically. Like, my your Americans in your audience will no doubt be aware of Jeannie Mae and Fannie Mae and Freddie Mac, especially if they remember the Great Recession, because Fannie Mae and Freddie Mac got put into receivership. They had these epic collapses during 2008 and 2009, and essentially what these agencies do to waive a lot of details is they guarantee mortgages, and they are sort of the originator of a lot of these mortgage-backed securities. We call them agency mortgages, and agency pools, because they come from these agencies, which aren't really federal agencies. Like I said, we'll have to smooth some details. They're sort of like government-controlled private companies. Some of them are even publicly traded, but they sort of operate in this weird, like the Federal Reserve. It's not quite public, but it's not quite private. And beginning in the late 60s, Freddie Mac comes into existence in 1968. As people probably know, in the mid 70s, we had this oil shock that was caused by geopolitics in the Middle East. OPEC did all these things, and we had this recession. Well, and one of the hopes with these agencies is that we could make houses more affordable to lower and middle income Americans. And the way that they came up with doing this was to sort of double down on an idea that came from the Great Depression and the New Deal era, which was this 30-year fixed rate prepayable mortgage. Because if you can spread the payments out over 30 years, it makes it more affordable, especially when all the troops came home from World War II. We wanted them to be able to buy houses, to have that the American dream. That's a sort of kind of the beginning of that. And so once these agencies started to securitize pools, then private banks in the mid and late 70s got in on the bandwagon. And then since then, it's just like, like that hockey stick curve that every economist loves, to the point now where we're probably not that far away from a world where shadow banking is actually bigger than traditional banking. Most of the growth in the financial sector has come in the form of what we would call shadow banking. It's just, it's on this never-ending curve. It did have a huge hiccup in the great financial crisis. Mortgage-backed securities came back and have exploded since then again. Asset-backed securities, not so much. They haven't quite recovered, but that is picking up a little bit. And just for those who don't know the difference, mortgage-backed securities technically are asset-backed securities, but normally when someone says ABS or asset-backed securities, they're talking about other debt instruments like auto loan is a popular one, credit card receivables. That's right, you can invest in people's credit card debt if you want. These aren't as big anymore, but there used to be student loan asset-backed securities or slabs. And there's just, I couldn't list them all. There's just like a million examples of those. And so I think housing, like I said before, the politics of housing is deeply caught up in mortgage-backed securities because that was sort of the goal. From the very beginning, the federal government, under the Johnson and Nixon administrations, wanted to know, like, how can we make housing more affordable? Now, you might say, I don't like the answer they came up with. Maybe they should have just done more public housing. Maybe they shouldn't have turned to the financial sector. But that's where we are. And so without the federal government guaranteeing these mortgages, we wouldn't have the 30-year mortgage, which, like I said, is prepayable. If you want to pay your mortgage off, there's no penalties. Banks are okay with this deal, even though it's risky, because the federal government is always standing behind them, ready to say, okay, this is a guaranteed mortgage. If they default, we've got you. And so without this sector, we probably wouldn't have that normalization of the 30-year mortgage. Now, I will say in the 2022 New York Fed report that I mentioned before, they are actually openly skeptical about the idea that this has made mortgages more affordable. What I will say is it's sort of murky. You can find papers that say, yes, it has made them cheaper. Some that say they don't do anything. That's an open debate still.
I suppose the question is whether, once you get into housing, it's a big political. It is kind of. We don't have the American dream here, but it is a big thing here as well. Housing, and I think if you campaign, it's like it's one of those things. If house prices go up, then it's bad because houses are becoming more affordable. But if house prices went down, that's also bad because everybody is going to be in negative equity. So I suppose, I guess the question is, and we're getting into the housing debate a bit now, but can we sort of, maybe house prices are on a sort of, a plateauing or like slowly increasing if we build enough houses, right? And then it sort of eventually over time, it sort of everything else catches up with house prices and they're actually proportionate to everything else in the economy. That seems to be the only workable solution to me. Obviously, it might be quite hard to achieve.
I'm going to just be upfront and say I have no idea. That's such a complicated thing. I agree with you. That does seem like, that's the problem with like you said, housing prices. When they go up, people who don't have houses are pissed. When they go down, people with houses are pissed. And so no matter what happens, like, unless I guess we just said like, actually, we're going to just try to figure out how to fix the price of houses to inflation and make them go sideways in real terms. I don't know. And I think even that would make people mad to have houses. Because they're like, oh, it's not appreciating. Like,
it has to appreciate as much as real interest rates, right? Like, so it's not just inflation, it's interest rates, right? So, there is the debt jubilee, which is something that a bunch of people have proposed, right? Like Steve Keen's proposed that, writing off some debt. Does that seem like a workable thing to do to you?
I'm a little biased because I will say I wouldn't like to lose my job because the bank went under. But I don't think it's a terrible idea. I've read Graeber, I've read Hudson. I'm sort of familiar with kind of the logic of these arguments that we have become over leveraged again. And I think that's true. Like in the United States, we have these headlines about credit card debt is over $1 trillion, default rates are going up, delinquencies are going up, average credit card debt is going up. There's all these things where it's like, yeah, the economy is over leveraged. We have too much debt, which and I think Randall Ray actually was the one that is where I read this, and I think he was talking kind of just after either during or just after the Great Financial Crisis, when monetary policy was sort of targeted at like, how do we restart borrowing? A lot of people don't know that. It's crazy now because we just went through the inflation crisis, but there was like the no inflation crisis for a long time. For years, it was like the Federal Reserve is like, over there with the paddles, like desperately trying to like revive inflation and couldn't do it. And Randy Ray was one of the ones that pointed out, like, well, it's because the way you want to do it is through borrowing and debt. Didn't we just go through a debt crisis? Like, why are we so eager to get back to it? So I think one advantage of something like the debt jubilee is, again, like I said, I'd be really sad that I lost my job, but trying to be a bit more selfless and think of other people, I do think it probably would help.
I think the
it'd be deleveraging.
The proposal as well from Steve was actually like a kind of one-off payment to everybody that they use to pay off their debt. So it's not necessarily a case of making the banks go bust. I think it's almost, I mean, I guess in accounting terms, it's kind of a transfer of the debt to the government sector, right? Because the government pays everybody. And then I think you're obliged to pay off any debt you have before you can spend the money, right? And if you don't have any debt, then you get like a windfall. But for most people, they'll have to pay off their debt or use most of it, like $50,000, let's say, to pay off their debt. And then that kind of shores up the balance sheets and transfers. Because Steve Keen's whole thing is like private debt, right? So private debt would go down, public debt would go up commensurately. But obviously, as post-Keynesians and MMTers, we're not so bothered by that.
Right. I think I'd have to sit and think about it more.
Sure.
I'm not opposed to that.
No,
approach,
we need an answer. We need an answer now. Yeah. We need yes or no.
Let me do my full analysis. So I think there's pros and cons, right? So I think that's definitely a better approach of the debt jubilee, because again, I do think that a lot of people agree with me that we are over leveraged. Again, this isn't our first rodeo with it. We're probably going to keep doing it. Minsky would say we're just going to keep doing it forever. Like, as long as money manager capitalism is alive and well, we're just going to keep reliving the cycle.
Sorry to interrupt, but didn't and not commenters might get annoyed with me for naturalizing capitalism, but hasn't Michael Hudson argued that this actually predates capitalism as well? It's the sort of the growth of debt and eventually sort of overwhelming civilizations is something that you see throughout history.
Yeah, I mean, well, even before like money, right? Like, Michael Hudson talks a lot, like, if we go back to like ancient Mesopotamia, we find debt crises, and that I think that's where the Jubilee stuff comes from, if I'm not mistaken. Is these kings and I'm not a historian. I'll just be upfront. What I know about this comes from Hudson, so I don't read cuneiform tablets or anything.
No, we let Michael Hudson read ancient Assyrian tablets so that we don't have to.
So I don't have to learn how to do that.
I'm glad he's around.
Right. So it's this very old thing. Capitalism is just like another one of these words that I think is often not helpful for the reason that you've talked about. You just said naturalizing capitalism. I don't know that I've ever asked two people to define capitalism for me and even get answers that are even consistent with each other. Or, there's kind of like the Sam Bowles take, where it's like capitalism is just the relation between the capitalist and the worker. If you ask libertarians, it's like, it's individualism and freedom and markets. It's like, I don't even know how to square. You could argue those are compatible. I mean, a libertarian would say, that's the same thing, but finance is much older than capitalism. I'll put it there. For the Hudson, David Graeber. And I think this is a much more common view now, that, there's these social credit systems. And I'm sure anthropologists and historians are just shaking their fist at us, like finally they're, like economists are catching up on this.
I like to think of capitalism. I'm going to give you another definition now, but no, it's not actually a definition so much as like I think of capitalism as like something that we do in certain places and certain times, right? So it's like, when you go to your job at the bank and you work for them for a wage and so that they can turn a profit, you're kind of doing a capitalism. But that doesn't mean that everything that you do is capitalism. There are so many spheres of life that aren't, whether they're like government sector, household sector, community organizations, maybe charity as well, right? So there are so many things that aren't. So I think that that there's this tendency to think of capitalism as very all-encompassing and insurmountable, and this is where you get the sort of leftist, but why aren't you talking about capitalism? And it's like, well, for me, capitalism isn't actually everything, right? And maybe even within the financial sector, to return to your point, we don't have to think of all of those relationships as like in necessarily capitalist. Perhaps some of them predate capitalism. Perhaps some of them can move beyond capitalism, building societies, for instance, and a lot of credit cooperatives and things like that, right? I would, in my ideal socialism, I would have those systems, and those are financial institutions, but I don't think they're necessarily capitalist in the way that's commonly understood.
Yeah, I agree. And on the note of like the cooperatives,
Yeah.
I kind of think that we do need something like that. Even if and I'll just be upfront. I have mixed feelings. Know a lot of people will try to pin me down on this capitalism socialism divide.
Mm-hmm.
I think there's pros and cons to each, and it kind of depends on, again, we mentioned it's this definition argument that's, even after what
Yeah.
you said, I can feel the tanky like fingers hitting the keyboard and just going crazy, because I'm sure we both said things that contradict that specific definition. But I do think credit cooperatives and credit unions, like I personally bank with a credit union, um, because I feel a little better about it, I guess. And I do think that that's a better form of credit creation. And maybe that would be one way we could, if you were talking earlier about regulating or reforming the financial sector, maybe that would be one approach. Something where it's a little more locally accountable, where your customers and shareholders are the same people. Like not only do I have deposits at Community America Credit Union, but I am a part owner in a sense. Like,
Yeah.
I get to vote on things that they do, and they pay me a dividend.
Mm.
And so maybe that would be, you could say, like, I guess if we were neoclassicals, we'd say like that aligns incentives better.
Yeah.
But yeah, I don't, it's just, you always have to ask someone like, what's their definition of these words before I'm willing to take a position. Because otherwise, like, if I say, oh, well, I guess, I'm a capitalist, they'll be like, oh, so you hate orphans. And it's like, well, I don't like that version of it. But, or if you're like, I'm a socialist, and they're like, you hate freedom. It's like, well,
Yeah.
maybe I don't.
Yeah.
Maybe I don't hate freedom.
Yeah. I hate freedom. I really do. So I want to ask you about this regional bank crisis, because you've mentioned it a couple of times, and you mentioned it before we started, and this is kind of something that you're noticing now. And if I think for a lot of people, right, we've discussed the global financial crisis of 2008 quite a lot. A lot of people have sort of been thinking, what's the next financial crisis? We've had crises, but none of them, I don't think, have been instigated by the financial sector. So is this it? Is this it? The sort of brewing regional bank crisis in the USA?
Yeah, so I'm going to start with I don't know. I don't have a crystal ball, but I will explain kind of my
Yeah.
reasoning for why I think what I think. Um, when I was doing my initial research on this, I read this. It was during a congressional hearing. It was a lawyer for the American Securitization Forum. This is 2006, so almost exactly a year before the crisis kicks off. And he's talking about, oh, securitization is great. It's risk free. Everything's going to be great for so long, And I don't want to be that guy where I make the comically wrong prediction about how it's going to go. So I think where we're at with the regional bank crisis is, I think for a lot of people, they would say it's over. A lot of people say it's the regional bank crisis of 2023. It happened, Signature, First Republic, and Silicon Valley. They bit the dust.
Mm.
Silicon Valley is a little different. It is connected, but that
Yeah.
one had more to do with like the crypto stuff.
Yeah.
Um, and these regional banks had these issues. Well, I think where I differ from a lot of people on the regional bank crisis is I think that it's alive and well. Um, and it's just been a little while since there's been a casualty. We did have Republic First, which annoyingly we have to distinguish from First Republic. The First Republic was a bank that fell last year, and then this year we had a bank failure from Republic First. Bankers are not creative people. We don't come up with different names. But essentially, earlier this year, either I think in like January or February, um, the local Federal Reserve um, bank uh, of Kansas City, we're the 10th district. They released these two economists released a white paper that was talking about there's this trend that got noticed. So in banking, we have this term called the net interest margin. Essentially, it is the interest that you collect from debts that from like lending out money minus whatever interest you have to pay in your own obligations, namely deposits. Net interest margin is sort of probably it's one of the most important measures of profit in traditional banking. If I'm lending out $1 million at 10% and I have $1 million in deposits at 5%, then my NIM is 5%. Now, normally when interest rates go up, so the Federal Reserve, they increase the federal funds rate, normally NIM expands. There's a lot of debate as to why exactly. For me, it's as easy as it's easier to increase the rate of interest for loans and simultaneously not increase the interest as much for deposits. Because you're just like one guy, I don't know much about your financial situation, Cahill, but I assume you're not a millionaire.
No.
Yeah. And so it's like, well, you can take 0.5%, or you can go next door to the other guy who offer you 0.5%. Your call. Like, we don't care. Whereas on the liability side, we're very sensitive as a bank. We're like, oh, if the interest rate shot up to 5%, well, then everyone needs to move up because the federal funds rate is sort of the floor interest rate for the banking system. And so normally, like I said, interest rates go up and NIM expands. Well, what these two economists at the Kansas City Fed noticed is that there's like sort of this frown in the data where like it started to go up, like NIMs as a whole, especially these small to medium sized regional banks, they were going up, but then there was kind of this unexpected dip. So essentially regional banks aren't performing as well as the Fed's models and theories would predict. Well, the main culprit they identified was commercial mortgage backed security exposure. A lot of these regional banks, like I said, we came off this decade of 0% interest, basically. There was the free money decade. We can get into all that because there's a lot of other interesting things that come out of the free money decade. But an important thing is just that people chase yield. If mortgage-backed securities will pay me a better yield than government treasuries or my savings account, what have you, then it just makes sense. Well, the flip side is that when interest rates went up, and this isn't the first time, this happened in 2006 as well. The Federal Reserve in 2006 increased interest rates, and it causes shocks in the mortgage-backed security market. Because when interest rates go up, essentially like imagine if we had mortgage-backed securities at 4% and the government sets the interest rate to 6%. Well, I'll just sell my mortgage-backed securities and buy treasuries because they're safer. And so you get this, you can get this downward pressure on prices. And so they raised the interest rates to deal with the pandemic inflation. We don't have to get into this either, but I don't know that that's what I would have done. But it put pressure on the mortgage-backed security. Well, the other problem is borrowers were really, really leveraged. You have these people that were buying apartment complexes, and they're paying a ton of debt service. Well, they started this loan 5 years ago, and now they need to refinance. A lot of these are interest-only loans with balloon payments, which just means they don't make any payments on the principal. They just pay the interest for 5 years, and then the entire bill comes due, and they find another bank to refinance. Well, now the interest rate's way higher. So when they go to refinance, they might find, oh, wow, my monthly payment on my debt is like twice what I collect in rent. Yeah. And so I'm now underwater. And these are, they're called non-recourse loans, which just means that If you default on the debt, they just repossess the collateral and you don't owe anything anymore. I could just, if you're the banker and I bought an apartment complex, I'm like, I'm just going to quit paying for it. I'm just going to mail you the keys to the apartment complex office and it's your problem now. Well, no one's going to refinance a property that is losing money.
Yeah.
That's just ridiculous. And so that puts more pressure on the system. Not only is it because these mortgage backed securities based on them can default, but because now there's a selling pressure. And this is, like I said, this is very similar in many ways to the mortgage backed security story. The Schiller index for housing prices, I think, reached its peak in 2006 or early 2007 and started to come down. And so some people found actually the value of your house is less than the mortgage. And when that happens, the bank forecloses because now the loan is under collateralized. You owe me $1 million, but your house is only worth 800,000, and that makes me uncomfortable because maybe you don't make enough that I think you could pay the 200,000. And so, and this I think will only continue going forward. We're going to see more of these defaults. There's going to be more pressure. The obvious one is office space because that comes from the pandemic. In the American news, this is a constant debate about work from home versus work from office. Well, the reality is a lot of office properties are doing really bad, like even just publicly, like they're not performing well, and it puts pressure. So banks that had a lot of this office space exposure, they're not doing so hot right now. And so I think to say that the regional banking crisis is over is very premature. I'm not saying this is I'm not saying this is the Big Short 2 Electric Boogaloo or anything like that. We're going to go through it again, but I think there's more. We're not out of the woods yet. That's how I'd put it.
Mm. Is it more, well, regional, dare I say it, right?
Yeah.
Like, is it less linked up, less of a kind of web than perhaps 2008?
Yeah. So there's essentially two ways to answer that. So regional banks suffered a lot in the Great Financial Crisis.
Yeah.
A lot of them were engaged in mortgage origination, or pardon me, were involved in the securitization process. And they tend to be the canary in the coal mine. If the regional banks start to go under, that may be evidence of greater harm to come, that there may be cracks forming in the whole system. But it could go the other way. Maybe Goldman Sachs and JP Morgan Chase will be okay. They have really deep pockets and they may not be exposed. Maybe they learn their lesson. So it's hard to say. I mean, financial economics is like meteorology. It's like I can tell you what the weather's likely to be tomorrow, but a
Yeah.
year or two from now, it's anyone's guess. Especially when things like the pandemic happen randomly, which is sort of what started this. The regional banking crisis in large part is just the echo of the pandemic. People start working from home more. We didn't all switch back to work from home. Now there's this like labor capitalist struggle about where do I do my work from. So office space does poorly. Then we have the supply side crisis. I think you and I both largely agree that the recent inflation is largely supply
Yeah.
chain issues. Well, then the Federal Reserve raises interest rates to combat that, which I don't think makes any sense, but that's what they did. And so they, lit the match that has ignited maybe another panic in mortgage-backed securities. So it's kind of the pandemic just sort of, the dominoes fall. It's like that, the meme where it's like the little domino
Yeah.
goes up and hits the big dominoes. Like,
Yeah. Yeah. I mean, is the wait a minute, I forgot what I was going to ask now. So is this a symbol? Because you were talking about like real changes, right? Like I don't always like that word, but real changes, like people working from home more. Is this collapse of these banks sort of necessary in a way if we're actually seeing a shift in the underlying economy and their business models are no longer sustainable? I mean, is it actually just a consequence of that shift? And I know there's this whole shadow banking, the mortgage-backed securities and stuff built on top of it that aren't necessary, and it may do more damage than it needed to. But the point is this a decline that we need to manage if we're seeing these empty office spaces, for instance, grow?
yeah, I do think there are things that we can and should do. So to sort of return to the first part of your question about like, is this just like, there's been real changes in the economy? I do think that is a big part of it. Um, the work from home versus work from office issue is probably going to be alive for a while. I don't think that's going to resolve anytime soon. Um, and I think a lot of people are like me in finance where we work like half the time in office now. And again, it's always this very tense thing. Management suggests maybe we'll go back to work from office only. And, workers will say, well, that'd make us really mad, and it's kind of the new, I don't know, it's the new battlefield for managers versus workers. And I do think that in a sort of Schumpeterian way, maybe we should let this business model fail. Now, there are things we can do to help it.
Yeah.
Some cities have been working on like, what do we need to do legally and technically to turn office space into housing? It's not straightforward. It's not that simple because office buildings are just not built the same way. But I think it's a great start. I mean, I would love to see more of it. God forbid people actually live in these high-rise buildings that we built. Like like how big cities can have like skyscrapers that are half empty because of work from home and have homeless people. It sort of does raise the question of like, well, let's just.
Yeah, it's interesting that because people always talk about empty houses, don't they? And they say there are more empty houses than there are homeless people. And I do actually
On
think
aggregate
that stat is bogus, by the way. I don't think that's a
okay.
sensible stat because it's partly about sort of friction and, people sort of moving, and there are always going to be some empty houses, and the houses aren't necessarily in the places that people want to move and all the rest of it. Which isn't to say that we shouldn't give homeless people houses, by the way, because we should. But it's just that office space is actually an argument that in that debate, no matter what you think of that statistic, it gets excluded. And I actually, until you just said that, I hadn't thought of that. You've got all this definitely empty office space that isn't being used that people aren't allowed to live in. It's absolutely ridiculous.
And to be clear, I'm not the first one to have said that. I won't take credit for anything, but I think it does neatly
Mm.
solve a lot of the problems if it can be done on time. That's for me is where the problem is that if you're a borrower with office space and you've got payments in 3 months where you're sitting there looking at your financials and you're like shit, I don't know that we can actually pay this in time. It can take many months to renovate a building in order to get it, up to code for housing and all that. And we don't want to ignore safety and all this. We don't want people living in, dismal cubicles or whatever if we can help it. But I
Mm.
do think it can solve the problem on many sides. One, we'll start with the most important one, which is homelessness,
Mm.
an issue that's more important than anything in finance. I'll go out on that limb.
Yeah.
Um, two, it helps the borrowers for these buildings because now they have a new source of rent, which is kind of the crux of mortgage-backed security is, prices and rent and interest. And then it could help stabilize regional banks that are exposed to office space securities because it would be like, well, it's not an office space anymore. We're reclassing it as multifamily, but it'll at least bring cash flow back up. It'll help them service the debt in the meantime.
Mm. Yeah. Yeah. So we've touched on this, but I do want to talk a little bit more about the macroeconomics of everything we've spoken about, and this relates to like MMT. So I mean, you are part of the the cult, as you've said before, the MMT cult.
Sort of. I do
Sort
want to
of,
throw
yeah,
the
yeah,
disclaimer.
yeah.
I've got one foot in the door.
One foot in the. You can't have one foot in the door of a cult. You're either in or you're out. But no, no, so I mean, I'm quite interested because MMTers, I find that they are actually often very focused on like the formal banking sector, right? It's a lot about central banks, and we've discussed some of it. It's a lot about monetary policy and government bonds and how all these things are intertwined. Perhaps a little bit less on the shadow banking sector. So I suppose you would see your research and your job in a way as kind of trying to bridge that gap. I mean, is that something that you're interested in doing for like a PhD and researching?
Yes, I think so. Things are still very up in the air. I
Yeah.
think that I will probably end up doing my PhD here at UMKC as well, um,
Hmm.
because of the kind of the niche little area that I fit in. So to go back to an earlier point, so yes, MMT is very focused on the role of the government. This goes all the way back to Warren Mosler. Kind of his original thesis was that the government, it controls the money supply. It's, it can control aggregate demand, in all these different ways. And even to go to so far as to say, Mosler would say that even if it takes time, the government sets the absolute price level. That it is the government's deficit and the government's spending that ultimately sets that. So they're very focused on that side, and that side is very important. I don't want to downplay any part of that. I think, I know I seem hesitant to accept the MMT title and all of that, but the reality is, like, we probably agree on 90% of things. Yes, I just do think that's how government spending works. That is how the central bank, especially the Federal Reserve, that's how it interacts. There's some parts I don't find as persuasive. I think where we really differ is that I put a lot more emphasis on endogenous money. Which, for those of you who in the audience who don't know all of our cool MMT terminology, it's just bank money. Endogenous means it just comes from inside the system. So, when a bank makes a loan, they don't go to their vault and look for a gold bar to give you. They create a deposit account for you, and then they put on that same amount, they create a loan, which for you is a liability and for them is an asset. And then your deposit is for you an asset and for the bank a liability. And so they kind of create this new money
by
in
the
the
magic
system.
of double entry bookkeeping. It cancels out.
Right. Yeah. So net assets are still zero. Now, that's an important point when it comes to MMT, is that one of kind of the central problems with the way that we run things now, whether you want to frame this in terms of the job guarantee or just their description of the monetary system, is that if the government doesn't create enough net financial assets, because the money that it creates is a liability of, it's technically the Federal Reserve. The Federal Reserve has these reserve balances and cash, which are their liabilities. But because they can sort of shirk their liabilities in a sense, like they can just let the debt rack up, they can create assets for the private sector. The government, the Federal Reserve creates reserve balances, it gives it to the banking sector, which is now assets. And so the government essentially there has a lot of power to change the net financial assets, which is important when we get into shadow banking, because the private sector is not allowed to do this. When the bank wants to lend you money, even if it's in the form of a deposit, it's endogenous money, they do have to do it on both sides of the book. Like it's really almost, it's like there's like, you end up with 4 entries because you have 2 entries in your balance sheet and they have 2. And so net financial assets don't change. They give you $1 million deposit, but now they have $1 million loan. So really only the public sector is able to change this. So when the banking sector does want to create more money, they also simultaneously have to rack up debt. Like the debt level has to increase, which is something that Steve Keen really makes a big deal about. Now, what I think, I accept all of that. Everything I've said in that story, I agree with. But because one of the primary roles of the financial system, and especially shadow banking, is to play around with these liquidity and maturity mismatches, they can smooth out a lot of these problems on their own. Like, sure, debt's going up, but so what? Like, we're all indebted to each other. Really, what matters, can I make my next payment? Like, I have a debt service payment next month. Can I make it then? We can smooth it out. We can securitize, issue bonds, buy paper, whatever we have to do. And I think that's an area that needs focus. And so to kind of answer your second question, yes, I think that is something I plan to go much deeper into. In the fall, I'll be working with Dr. Scott Fulweiler more on this topic. And he's really good on the MMT side, but he also used to be a finance professor, which is, I think, one of the main reasons I like to interact with him and take his classes and work with him on stuff, because you kind of need these two views. Like, economics without a coherent view of the financial system is guessing. It's just like, cool, you have a really good description of factories and Apple markets, but if we don't know how to securitize their bonds or all that, or how that plays a role in global finance, then a lot of things are going to catch you off guard. Like the great financial crisis often got chalked up by mainstreamers as like, yeah, it's like it's so unlikely, it's like a 1 in 8 quadrillion chance of these 3 trading days. It's like, no, the theory is bad. Like, not a 1 in quadrillion chance. It was coming. Like, people saw the signs that there were issues.
Mm.
So yeah, that would be my hope, and I'm nowhere close to that. If you can't tell, I don't claim to have any more of a
Well, no,
coherent
it's an
theory of
open
finance.
question, isn't it? And I guess it does speak to what I see as a tension with MMT, because I do feel like there's obviously MMTers are like me, endogenous money zealots, right? They'll remind you that loans create deposits and that banks create money in the process of lending. Banks don't look for a gold bar in their vault before they lend to you, as you put it. But at the
Yeah,
same time, there does seem to be this faith in the government to be able to control the total amount of money and demand in the economy, which I feel like is actually not true because of endogenous money and especially the shadow banking sector. Because I mean, one way I see the shadow banking sector is just an increasing number of attempts to create things that are basically as good as money, right? It's just like, all these new instruments, and it's like as liquid as possible, and just trying to create things that are function as money, but don't necessarily have, they aren't notes and coins. They don't necessarily have the direct approval of the government and the central bank. So there's all of this going on outside of the kind of formal sector. So I feel like whatever government policies were put in place, and there's things like the job guarantee, for instance, and the uses of taxation and stabilizers to manage inflation. I'm not necessarily against any of those things, for this purpose anyway. But the point is, like, does the government necessarily have that level of control, or is it all just going on in the shadow banking sector, right? And that's like less easy to control. I mean, does that make sense to you as an objection to some of MMT's policies, at least?
yeah, definitely. And we could go even a little deeper than that. I can't remember the guy's name. I should have looked it up before we did this. He did an interview with Money and Macro, which I assume a lot of your audience watches, and he was talking
Yeah,
about the
Yuri
Eurodollar
Shusful.
market. Yeah, yeah, Yuri, and he was interviewing this guy that's all about the Eurodollar market, and he was talking about like the term structure and
Mm.
how much of this stuff even happens outside of the United States, even if we're just focusing on the American financial
So
system
we have to keep interrupting each other for jargon, but it's just the euro dollar market. Confusingly, has nothing to do with euros. It's just the
or
dollar
dollar.
market. It's just that. Sorry,
Yeah.
no, wait. So maybe I was about to get it wrong. Please, you explain it.
No, I was just kidding. You're right. It's
Oh,
they're essentially dollar denominated accounts that are held usually by foreign banks or foreign holders. So
oh, so it does
um,
have to do with that. Sorry, I thought you were
yeah, yeah.
actually correcting me. You were just joking.
No,
I was
no,
like,
no,
well,
no,
have I
no.
got
I'm
it completely
sorry.
wrong?
Yeah,
No, no, no. So it's the dollar market in Europe, essentially,
yeah,
right? Crudely, to put it crudely.
yeah,
But yeah, please carry on anyway.
yeah. So in well, I think I always think of with euro dollars, and this is maybe more of my gamer side, is that's what the currency is called in cyberpunk. And so, when I've brought up euro dollar markets to my friends, and they're like, "Oh yeah, like Eddie's in cyberpunk." I'm like, "Well, no, no, no. Like it's kind of this other thing. It's really just dollars." And what's even more confusing about the name is it came about before the term euros. It's much
Right.
older.
Yes.
It
Yes,
goes
it
back to
is.
like the 50s,
Mm.
I think, like this post-war period. Because, and this is I think Michael Hudson talks about this too, is that money is essentially sort of like a measurement. When you say a dollar, that's like saying, maybe I shouldn't say a pound because that's also a currency. Like it's 1 meter long. This
Mm.
is a meter of distance. This is a dollar of economic value, or however you want to frame that. And so euro dollars, like you said, they're accounts that are denominated in dollars, but they're held abroad and may actually not have dollars. And the euro dollar market is huge. Um, I know a lot of foreigners interact with it all the time. You know, on Patreon, if you're receiving dollars from people, I don't know the specifics. I don't know if they're putting dollars in your account, but it probably touches the euro dollar system at some point. So that within Britain, you can get pounds instead of the dollars that an American is sending you. I know Yuri has talked about this, like, you know, dollars are sort of the go-to currency for him because he hires people as like editors and other things like that abroad, and everyone quotes their prices in dollars. And the euro dollar market is just sort of the mechanism of, where are these British and Dutch people getting dollars? Well,
Mm.
they may not really have dollars in the physical sense, but they have dollar denominated accounts that are in some way attached to the American financial system for clearing purposes. Um, And so to go back to what you said, I think of money kind of as like a, and then, this is a long debate. What is money actually?
Mm,
Money is how you pay for stuff, is how
mm,
I think of it. If you'll take Bitcoin from me, then that can play the role of money. If you'll let me pay you for dinner and mortgage-backed securities, then maybe they have this money like. But there's sort of this hierarchy, and this is something that Scott Fulwiler talks about a lot. Is like there's this hierarchy of money. At the top, you have like the government money, and then as you go further down, it's someone's obligations. And so one of the issues is as you go down lower in the hierarchy is it can be harder to exchange. Like if I showed up to the IRS to give them a like my IOU, I'm like, hey, will you put it on my tab? Like here's a Connor bond. They'll say, no, man, you need like dollars, like government
mm,
dollars or deposits or something that can clear through the
mm.
system. And so you get, these obligations form this hierarchy, which in large part is going to be political, I would say, about power.
Yeah.
I don't have a giant military like the federal government does, so I can't demand that people accept my liabilities as payment,
Mm,
which is also a big part of the MMT story. Like Matt Forstater, he talks a lot about like, how like there's this power dynamic like with the colonial empires of getting, like especially not to call you out, but the British with their colonies, they would want people to use their own currency to bring people into their own system, and so
mm.
they
No, it
would
was
use
good
things
for
like
them. It
taxes.
was good for them. We did
Yeah.
it. We did it to benefit them.
Uh, no,
Yeah.
I'll I'll
you're
leave you to that
you're going to
opinion.
leave that one. People are
Yeah,
asking
no,
if we're going to make a bottle cap reference to to Fallout New
yeah,
Vegas. So yeah, but that's a good example, right, of where bottle
right,
caps, but yeah, bottle caps become accepted as the currency, and that's just like because they're accepted. And it's about power. I would also add that it's about trust, right, as well, which is
yeah,
um, not always to do with power, right? Like, I mean, if you gave me an IOU with and depending on how much it was for, I might be like, okay, or effectively gave me an IOU, right? Like we all owe our friends money or are owed money by friends and family at different times, and because we trust them, it's like that has effectively turned into money for them, right? Like they've taken out an account at the Bank of Connor. It's just that we don't necessarily think of it in the same way, and it's not underscored by these formal legal mechanisms. But that's like a type of money, a type of financial asset, right?
yeah. And where it gets confusing, I think, is that it's all dollars. So if okay, so we go to a restaurant
Mm.
together. I don't know where's good in London, and I pick up the tab. I'm as an American, I'm sticking with dollars in my analogy. Um, the dinner is $20. Um, you don't really like directly issue me an IOU, but you sort of do. There's an understood one. Like I
Yeah,
pay the restaurant, I fund it like a bank. I'm
yeah.
like acting as your credit card, and then I'm like, yeah, you owe me $20. Really what we've done is we've kind of exchanged these like the IOU, but we've denominated in dollars. People do
Mm.
the same thing even with things that aren't debts. Like I have $1,000 in Bitcoin. I have $1,000 in Tesla stock. I have $1 million in mortgages. We're using dollars, even though many of these things aren't dollars,
Mm.
including your bank account. Your bank account is denominated in dollars or pounds, but it is not money. You
Mm.
don't put money in the bank. You exchange money with the bank for a financial asset called a deposit. And the fact that these are all just dollars, I think that's why this can get confusing. And that's why I think in a sense these things are all money because we measure them in units of money, I guess, to be like physical, like they all have like this mass to them, where we can measure it in dollars or pounds or euros or whatever, and so they function as money if you will accept this payment. Now I think where the MMT approach is a little different from that is they would be like, well, money is just the liability of the state. There are other things that can function like money, but I think it's for them it's more important to distinguish like, no, this thing that the government does that's like real money, or like
Mm.
um what do Godley and Lavoie call it, like high powered money.
Yes.
Yeah, and then there's kind of like soft money or bank money. I think it's okay to be a little more fast and loose. Most people are not sitting at the gas station wondering, what are the exact mechanisms? Like, is this true money that I paid for my gas with? It's just
Yeah.
no, they accepted it, so life goes on.
Yeah, we don't think about it in that way. I suppose it's really interesting, isn't it? Because, but at the same time, the fact that people don't understand this very well, and they just like money for them is highly guaranteed, and what they think of a deposit as the same as a note and coin, and possibly as the same as a couple of other things. That when you get something like the 2008 financial crisis, that's when it all becomes apparent that actually no, you were lending money to your bank and they don't
Yeah.
have it. Right. And like, so I guess I don't want to I don't want to in a podcast about the financial sector conclude by saying everybody should learn a bit more about the financial sector, because that's what everybody always says.
Yeah.
And actually people do learn about that, do learn about that at schools, and they forget it just like everything else they learn at school. So that's a crap conclusion, but you do wonder, I don't know how we should understand it, right? And like, I guess where the technicalities meet the kind of political reality and the things that people take for granted, it just sort of because maybe some way or somehow that could be communicated better to people. I have absolutely no idea how, but it just seems like something that people just don't realize they're lending their bank money. They don't realize that some of the things they own aren't actually quite money or aren't as guaranteed as other things. I mean, you were hinting that maybe you don't see that as much of a problem, but I'm not sure.
So I think I agree with what you said. It becomes very obvious in the 2008 crisis, but we're so fast to forget. When times are good, it's just like, who cares? Like the grocery store accepted my debit card. I don't want to think about how this involves Eurodollar markets or how it, like whatever.
It's
Like
fair enough, yeah.
I just want my groceries to just go home. I don't know that it's a big problem. And like you said, I don't know if the takeaway from this is you should go learn about the financial system.
Mm.
It's not always entertaining, for one. I mean, when I'm sitting there reading what the Federal Reserve is saying about mortgage-backed securities, I'm like, wow, this is really boring. Like I could be playing Steam games right now. There's all these other, which isn't to say if you're interested, go do it. It is so important to understand this stuff. But I think it's okay to have kind of this high level view. And I think part of it is on us who study these things and, who talk about them to make them understandable.
Yeah.
Like don't rattle off a bunch of MBA and finance jargon at me. And I know I'm not perfect at it either. I've used some jargon here and I'm trying to translate it a bit, but just say what you mean, and just make it more digestible. And one, I think, and this has become a real touchy political subject in the United States because we just had this, this overturning of the Chevron decision. And I'm not a lawyer, so I'm not going to be able to give you the legal eagle fancy description of it. There are videos on it. You can go look it up. But essentially, regulatory agencies don't have quite the power that they used to in interpreting like their own standards and things like that. And I think in finance, that's devastating because I don't, the way these things can work in the specifics is really complicated. Again, I don't think even Zoltan or Daniel Gabor, I don't think any of these people claim that they understand every part of it.
Yeah.
Because there's too much to understand. There's too much, you have to start getting these like sub focuses. Like, oh, I think before long we'll be like, well, I only study like repo shadow banking or just just because of there's so much going on. But I think people should at least be sort of aware of it, which is why when you told me the title of this was Shadow Banking 101, I was like, that's great.
Yeah.
If everyone could have the 101 understanding, I think they'd be better informed to know, if a lawyer is in a congressional hearing trying to sell you on these financial products, you at least know a little bit to say, oh, actually, maybe there are risks, or maybe regulations are good. Maybe I don't trust the financial sector, or maybe you have the opposite take. You're like, actually, these assets are great.
Yeah.
Like sometimes they are good.
I think it's like the onus is on the people who study these things, maybe also the financial sector itself, right, to be a bit clearer about, because clearly banks want you to feel safe in depositing money there, right? And that's kind of fair enough to a degree. But I mean, maybe there's no incentive. Maybe it's a little bit like the kind of ratings agencies thing, where it's like their incentive is actually misaligned, and really there should just be a little bit more knowledge, perhaps at the point of purchase, that you're lending them money, right? You're lending them money, and there is deposit insurance and everything, but there are still risks involved. And I mean, the lesson of Minsky really is that you should never think that the risks have gone, right, because they'll always
That's when
be
they're
there,
at their
no matter the
biggest.
system. Yeah, exactly. Okay, so yeah, that seems like quite a nice place to stop. I think.
Okay.
Always remember that everything is really risky, and you're never safe. That's what I want people to take away from this. From this
Yeah,
chat.
you're never safe.
You're
You're never safe.
Be afraid. I mean, is there anything that we kind of didn't touch on? Because I've got time. It's just that it's been a couple of hours, so it's about the length of a podcast. I don't want to be a Joe Rogan podcaster where you talk for 5 hours or whatever the hell he does.
Yeah.
Although this has been much more substantive than a Joe Rogan podcast, obviously. But yeah,
Well,
is there
thank
anything
you.
we haven't touched on? Yeah, it's a low bar. I'm really damning you with faint praise there, aren't I?
Yeah. I mean, I've got more time to talk if you want to. I was thinking, if we do want to go a little bit longer, if the
Yeah.
audience has questions, I can't see the audience comments. I knew
So
that
there
would
was actually
distract me.
one already, so people can ask questions. Absolutely, there are a couple that have come up, so I'll ask those first while people come up with their questions. So one person was asking about the postal banking proposal. Now, I don't know what this is. Have you heard of this?
Yeah, so essentially the idea, and I believe this is practiced in some European countries already, is that the post office would take on banking responsibilities. Um, there's a few good reasons for it. I actually do think this is a good idea. I like the idea of a public option. I know I was super skeptical of nationalization earlier, but I am okay with the government entering the mix. In the United States, the post office must legally service everyone that has an address. You could be like in the middle of the desert or way up in the mountains in Alaska. It doesn't matter. The post office has to figure it out. And so there's post offices everywhere, but there's not banks everywhere. There's like there's this underbanking problem, or like I've started to see discussion of like banking deserts, because there's like food
Yes,
deserts.
yeah.
Everything has to be a desert now. That's where we're at in the jargon. But yeah, and so essentially it could be a solution to banking deserts and underbanked people, is that the post office would essentially say, well, if you're an American citizen, or maybe even not, we will always be willing to act as a depository for you. We will take your deposits. We will take your direct deposit from work. We'll give you a debit card, and we may engage in a bit of credit creation. Now, and where that might be different, I don't know what the case is in other countries, but in the United States, our post office is sort of a strange entity in that it is expected to run at a profit. And there's like a whole drama. We don't have to get into this about its pension funding and things like that.
Yes,
But
yeah, I've heard about
and
that.
so and it could be another source of revenue for the post office, because unlike a lot of other federal programs, we expect this one to pay for itself. The post needs to run a profit. So it could just be a bank. Now, I think it would do really well to solve the underbanking problem, because like some people just don't have debit cards. And so you can't buy things online, and there's kind of this move towards, let's get away from using physical cash for all these different reasons. And this is bad for those people. A lot of places want you to pay your bills online. Like I pay my rent for this house through a web portal. That would be a nightmare if I didn't, because their office isn't that close to me. If I had to like physically go there, and hand them a check. Well, I guess I couldn't even hand them a check if I don't have a bank account. Like I'd have to pay them cash. So that part's good. The flip side is, do we really want the post office to be one of the banks that crashes in the next crisis? So I think they'd have to be really well regulated. We'd have to say, well, the bank or the post office can't be like securitizing letters from Santa Claus and things like that. They need to be responsible. Maybe something like secured lending, like mortgages, would be okay, but even that can be risky.
Yeah. Okay. Oh, good. I'm glad you'd heard of that. That's really interesting, and it seems like a really good idea to me. Absolutely. So another question was, what do you think of the capital requirements as a counter-cyclical policy instrument? Because that's something that's, I know the Bank of England definitely do that, and I think they're partially inspired by Minsky there, actually. So yeah, what do you think of that policy?
it's a good idea, and we do have it to a certain degree. In the United States, it's a little bit more complicated. The Federal Reserve assigns different like multipliers to different assets. So like government treasuries are very highly rated. Um, horse race tickets aren't worth, they probably don't rate up as much because they're so risky. And so they kind of scale like that. The issue, I think, with capital requirements, since we're talking about shadow banking and securitization, is that it takes a lot of these activities off balance sheet. Um, and so how do you design capital and reserve requirements in such a way as to prevent this kind of dangerous speculation when these things get listed differently? We obviously need some sort of capital requirements. We don't want banks, sitting at like 1,000-time leverage multiplier, or something ridiculous. Because someone would try, of course. They'd be like, I found the infinite money glitch. I'll just keep $1 in deposits in the bank and just lever up or something. But I think it's more difficult in practice to design those policies, because if you create them, and I guess this is sort of a Lucas critique or something. Okay, cool, you came up with these new capital requirements. I sit down with my buddies at the bank and we figure out a new way around it.
This is what Jeffrey Friedman actually said about the capital requirements that preceded the 2008 financial crisis, right? Have you heard this argument where he was like, that was what pushed banks into shadow banking type activities, because they were off balance sheet and the capital requirements were, either wrong or too stringent, or certain things didn't count for them. So the banks went towards those things, and that was part of what fueled the crisis, which seems like I'm not sure it's the whole story. I think
it's part of it.
Yeah, but Friedman, being a libertarian, is kind of keen to emphasize it as the whole story. But it was definitely there, right? And so that's still potentially a problem.
Yeah, and let me be clear on this. I'm not a libertarian, but the government had a role to play in multiple ways, right? One is through banking regulation. The other, like I mentioned before, is that the Federal Reserve increased interest rates in 2006 with the hope that they could cool the bubble a little. And instead, they just kind of sparked the crisis. Another thing that I've also seen talked about in this context is like Zoltan, he kind of talks about like parking space for your money, especially when interest rates are low and you're not getting good yields. You need somewhere to park your money. And if the government isn't offering you bonds that give you what you want, that can also push people, towards shadow banking activities.
Yeah, absolutely. Yeah, I don't like that debate, the government versus the market. Did the government cause the crisis? Does the market cause the... You know what I mean? I just like, obviously, there's a lot going on, and it's elements of both, right?
There's guilty people all around.
Yeah. There's plenty of blame to go around. Don't confine it to just private sector or public sector. You can blame everybody. So Ben Felix, who I don't think is Ben Felix the...
I was going to say, wow.
YouTuber. I don't think it is. No. Why can't we just be really harsh with regulation, get rid of this asset leveraging, asset stripping? Are there not these areas of the shadow banking sector where we're just like, right, you shouldn't exist, like, and how do we get rid of those, basically?
So the answer is yes, we could. Right? We could just... The federal government could just wake up tomorrow morning and say, we've had enough. We're just going to arrest anyone we catch, or whatever. We can drop the ban hammer if we want. I think the issue that we would find on the other side is that it would have lots of unexpected macroeconomic consequences. I think it would cause a recession, or very likely would, because, an important part of the endogenous money story, going back to that, is that bank money creation kind of plays a similar role as government deficits do in the kind of traditional Keynesian story, that they can credit fuels aggregate demand, right? Like if you lend people money, they can spend it. That's the simplest jargon-free way to put it. And so if we suddenly started chopping off whole pieces of the financial sector, you could get like a credit crunch. Now, is this an argument against doing it? Maybe not. Maybe you're like, I don't care. We need the recession. Burn the whole thing down.
This is like left wing austerity, isn't it? It's like, okay, austerity in the financial sector, short term pain for long term gain. Yeah.
And if that's something that you can accept, then I would say, sure, there's no reason you couldn't do that. I don't like the idea of making the financial system more fragile on purpose. Um,
It goes back to us not understanding it fully, right? And these risks. I suppose a follow up question would be like, what's a more moderate approach that you might take if you really want to prevent the worst kind of asset stripping? I mean, is it like an antitrust thing? Is it that kind of thing maybe?
okay, so there's a few different parts to this,
Hmm.
and I know this is one question, so I'll try to condense it a bit. So is one problem that I think that we have is that we have experienced huge consolidation in the financial sector in the
Mm.
last 25 to 50 years. I don't think that's controversial.
Yep.
You can just look at the bank balance sheets if you don't agree. Um, we have fewer big banks and they are much larger. Well, so one thing that this does is it creates these huge pools of liquid assets that can be pushed around. Um, some people have even gone. I've said this was like maybe a year or two ago. I saw this ludicrous article titled it was like are index funds worse than communism? It was
Oh
like
yes, yes.
yeah yeah like
I read that.
but there is sort of a kernel of truth in there that the financial sector exerts ever more influence from ever fewer people.
Mm.
You know, Jamie Dimon, he calls a lot of the shots of what goes on because he runs the largest bank in the world by a wide margin. So one thing now we can get into all the causes of that, but a big one I would say is how much the government incentivizes saving, which sounds like a strange thing to say. But if the government's like, well, we're going to make 401ks and Roth IRAs and all these other retirement accounts and products, we're going to subsidize them or make them tax free. Well, yeah, more people are going to leave their liquid assets in place. They're not going to touch it. Well, and then they go give it to these financial institutions, which then pull those assets under management and they use it to buy stocks, bonds, whatever. And that allows them to exert even more influence, which is really what that article that even had a crazy headline. It was really the point of it was that these huge passive investment funds exert huge influence, like kind of in the politics of financial space, because they have trillions and trillions of dollars of assets under management, and so it gives them abilities to cast votes. And in the United States, anyway, I think most people who hold index funds don't actually even bother to go vote or even let alone read the prospectus. And so
Mm.
what happens is that the index fund acts as your proxy voter. If you don't tell them how you want to vote
Yeah.
in like a board election, they vote for you. And so these guys will show up and they can cast like 30% of the vote alone. So, you imagine that there's some one person in Congress could do that, what would be the political ramifications? It's the same here. So one thing we could be is we could revisit saving. This is a whole other rabbit hole. There's like the ISLM model, investment savings and liquidity market. And there's this debate in MMT about like the mainstream is like savings creates investment. MMT and Post-Keynesians are like, no, it's investment creates saving. You get this
Mm.
back and forth. I think savings are probably overrated by the mainstream. I don't know if I go as far as maybe a lot of MMTers do, but at the very least, savings aren't that important in a world where banks can create money by issuing loans. When they create loans and deposits simultaneously, they can create the liquidity needed. So maybe we don't, maybe these savings incentives have created this financial consolidation in which, it's been tied to asset price bubbles and, there's all these other things. So that might be one way to attack the problem.
Yeah, yeah. No, I think that makes a lot of sense. I mean, I feel, as with the mortgage thing, I'm kind of is it feels like a lot of the ways of taming the shadow banking sector might be kind of indirect and not so much banning this or that activity because it's such a moving beast. I mean, somebody just said in chat, anyone who when you bans make lower quality money more acceptable because anyone can create money, right? And it's like
Yeah.
that's the type of thing. So if you're just like going in and you're like, oh, I'm going to ban this, it's like you might create something worse. And it's a really
Yeah.
this is what we were talking about earlier. It's actually while the shadow banking sector is very big and entails significant amounts of money and is quite historically specific, the act of creating money and creating instruments is something which is really, really hard to control. And so, you're looking at like these regulating like the source, like a mortgage or kind of antitrust and reducing the size of these institutions in the first place, rather than getting down to the micromanaging and banning. Because this is where I am kind of I think the libertarians kind of have a point. They're like, when you just go in and you really micromanage everything and you try to ban this and ban that, something else is just going to sort of come up elsewhere, and it may well be worse. I think that's a reasonable point to make. So yeah, I mean, that's what I'm hearing. It seems like there are ways of regulating the shadow banking sector and reducing its importance and significance, but they're probably more indirect than you might think at first.
Yeah, I mean, unless the plan is that we're just going to change to a totalitarian state tomorrow, that it can surveil every person and be like, no, you're not allowed to lend your friend $10, or, you can't, no, like,
yeah.
And I know that's hyperbolic. I know it would be way less than that, but like, it's just like we said before, if we go by the Hudson Graber story, then that is really old. It's much older than money, and it doesn't even require formal legal systems to operate.
No.
And it's complex and chaotic. And the thing is we kind of do ban products in the aftermath. The issue really, I think, is not so much on like harsh regulations. It's that we wait until the crisis to be like, oh, we should have done something.
Yeah.
Well, now we'll fix it. And it's like, no, you can't fix it. We're in the ruins now. Like the GFC happened. How do we be smarter about going forward? One thing I think is just taking finance more seriously. I like what you said earlier, like austerity from the left. I'm stealing that from you. You'll probably see me post it on like Blue Sky and things like that.
Yeah.
I really like that.
Because I'll block you for stealing my idea.
But it's just like, we're going to regulate this thing by killing it. It's like, well, that will solve it. You will not, if you ban securitization, you will have no more securitization-based crises. But what are the unattended effects of that? And how much do they hurt ordinary people? Because at the end of a lot of these things, for me, that's the real concern of financial crises. Like I'm not sad that Lehman Brothers is gone. I'm sad that a lot of people lost their jobs, and I was very fortunate. I mean, I was I was a freshman in high school when the Great Financial Crisis started, so it wasn't really on my own. And my mom worked for a school district, so she was a public employee. And so we were shielded from some of it, but I knew a lot of people that weren't. Like in my hometown, a suburb of Kansas City, people lost their jobs. People went through all these awful things. They had their homes foreclosed on, whole lives were destroyed. And those unattended effects can come from regulation or from the market. Yeah. Like you said, it's not about government versus market. Any changes to this system impact everyone. So we should have regulation and we should look into it, but I don't know that it's as simple as ban it and it's not as simple as the market will settle things. Both of those views, I think, are too extreme.
Yeah, absolutely.
And the evidence is stacked against them.
Yeah. Yeah. Another suggestion that I was going to say, and someone else in chat said it, is like public options, right? If you've got those kind of public alternatives to try and, keep things honest, relatively honest, not rip people off, and try and influence the market that way. Although I suppose Fannie Mae and Freddie Mac were kind of public options, and that didn't go too well.
Yeah, we didn't go too deep into this because that's where it gets really complicated. Yeah. Because even before they were in receivership, they were federally regulated entities. I mean, they were created by the federal government. Now, again, those are now publicly traded. You can buy and sell their stocks on the exchange. So they operate as for-profit companies, but they still use federal government guarantees. So there's still a degree to which they have to play ball. They can't just do whatever they want. I mean, and so even when you're like a public option, it's almost like we have to be more specific. Like, you mean, when you say a public option, do you mean the federal government should guarantee mortgages because they've been doing that for 50 years? It's the 70% of the MBS market is agency mortgages. Yeah. Agency mortgages also suffered a lot and were part of the mortgage-backed security crisis and the subprime mortgage. Now, they have stricter regulations, but if the whole market turns down, suddenly all of these things become correlated that may not have been. So even if Fannie has much higher margins of safety than a private bank, if the whole housing market is collapsing, that's not going to help you. And so should the government should the Federal Reserve just make mortgage loans to people? Maybe that's a public option. It's like, well, you can just sidestep this entirely with the Federal Reserve, postal banks or something. Because I
Yeah.
mean, in general, I am pro government options.
Yeah, but the
I like,
postal bank is potentially a better one than the Fannie Mae and Freddie Mac type setup.
yeah, because again, that's where it gets complicated. Like, are they public or private? Well, they're
Yeah,
government supervised, but they pay dividends, so
yeah,
there are private aspects to them.
yeah. They're quite similar to a corporation. I mean, corporations are also licensed and protected by the government, right, as well. So yeah. This is again why this distinction isn't necessarily helpful. People are talking about the Roman Empire in the in chat, which is better than the USSR. So I'll give you that. But Ben Felix, who is a different Ben Felix, says that Trajan was a micromanager and he was also one of the most successful Roman emperors. I don't know enough about that to comment to you.
I am not a historian
But,
of Rome.
yeah,
I've seen Gladiator and I've read a few things. I
yeah,
like the Invicta channel. If you're interested in Roman history, they do have a few episodes where they talk about the Roman economy on Invicta. I guess I didn't. They're not paying me to say this. I'm
yeah,
just
yeah.
free plug, but it is very. I do find that stuff very interesting. I love learning about like the history of economics and in the past, but I just know that whatever I would have to say would be crap.
Yeah,
I don't
yeah,
know what
yeah.
I'm
No,
talking
no.
about.
I wasn't really expecting you to
Yeah.
to know about Trajan, but men will always end up talking about the Roman Empire, right? As the meme goes. So,
Yeah.
but yeah, I think so. We can finish there. We've had like all the questions, or have we? Okay, okay. No, Toriel D comes up with one more, which is actually really interesting. So, what model of endogenous money do you find most useful?
Yeah. Um, I would say that I kind of, as my baseline, um, because I don't think we should be dogmatic about models. And I know we didn't get as much in the MMT drama, but I think that's part of it is that I you should have like a baseline. My starting point is very similar to Godley and Lavoie, that banks create loans on demand and money is the result of this because they create deposits and loans at the same time. Um, there are other approaches to that, like Steve Keen has kind of this more continuous dynamic model of
Mm,
it where there's like set rates and things like that. I think for me, an important constraint we have to consider is that both the bank and the borrower have to be willing. If the borrower can use retained earnings, like past profits, if they're a business, in order to finance things, and they might choose to do that. And if the bank is like, you don't meet my credit standards,
yeah.
there's no deal. And I think those things are sort of neglected oftentimes that like, because sometimes banks don't have choices. They're told by regulators, no, you have to hit these risk standards. So I kind of started in a Godly Lavoie place.
Hmm.
For people in the audience, I think it's called monetary
I
economics.
think it's just
If
called
you,
monetary economics. It's somewhere behind me. Um,
if you just type
yeah,
Godly Lavoie monetary
yeah, it's
economics, you'll find a free PDF.
yeah. Literally, that is like
Yeah.
yeah, that is the place to start, isn't it? For sure.
So I would say, like as a post Keynesian, that's sort of my starting point for endogenous money. But then you can get more complicated if you want, depending on what you're modeling. Um, like my current sort of interest with models is working more on models that include things like the housing market, like it's like a kind of like a physical stock in that system, and then trying to see like what kind of dynamics
Mm,
can I get even from a toy model.
mm, mm. Yeah, there's these debates between like the structuralists and other endogenous money theories, but I feel like it's been such a long time since I looked at those. I wouldn't be able to give you a good answer. But it's basically the degree to which money is endogenous or exogenous. I think this all comes down to, right. So it's like, is it completely sort of determined by the system and the central bank is just reactive, or is it somewhere closer to maybe even the exogenous money view of like the monetarists, right? And there's this all these different things along this spectrum, all these different debates. But yeah, again, it's been a long time since I looked at any of that.
Yeah. I mean, and all those things happen. That's kind of the reality is that everyone is an active and reactive player in the game.
Yeah,
The government does have its own money. Banks have their own money. I mean, if you're willing to take my IOU personal bonds, I can have money. That's where it gets complicated. I don't know. I try not to. I honestly don't overthink that too much.
mm,
But again, my view is more on the financial system. And so I think I have a different lens than like a traditional macro person does when it comes to endogenous money.
Yeah. Yeah. Maybe that's all something that we can discuss like another time as well. I mean, the endogenous money, exogenous money debate, and all of that. I'd like to refresh on that and speak a little bit more about it on the channel. But I am now going to say, because I need to eat dinner. Thanks very much, Connor, for coming along. It's been really interesting. And
Thanks
yeah,
for
we've
having me
chatted
on.
for a good while, and I hope everybody feels that they have learned a bit about shadow banking and banking in general, because I certainly have.
Just if I can, real quick, just like
Sure.
I guess a quick little plug or whatever. Again,
Yeah,
thank you so
please.
much for having me on. I do have a Blue Sky account for those of you who are using Blue Sky. I'm Connor N, the letter N Howell, at Substack.com. I think is if you just type in Connor and Howell, you'll probably find me. Um, I'm in the progress of getting a Substack set up so I can kind of write articles about this. It's not ready, but more to come. I'd love to come back at some point.
Yeah, for sure. And yeah, so I can post the Blue Sky in the description
Okay.
of the video. And the Substack, I guess, isn't active, but I'm looking forward to you starting to post on that. I'll definitely be reading it.
Perfect. Well, thank you so much. Everyone had really good questions. So
Yeah, really good questions. Thank you, everybody. Okay,
take
I'm
it
gonna
easy.
stop the stream. Bye.